Good morning, everyone, and welcome. Welcome to day 3. It's amazing to think we've already gone through 2 days, and I was just talking to someone before, just talking about the agilities of people's minds. That we've started out with life sciences, we're into medical device, we've covered venture capital, we've covered private credit, obviously a property focus, and always to me, I just think this is, and to me, I suppose that's what makes up the private market space. So today, we've got an absolutely jam-packed day covering all the things that are relevant for investors right now. And I said the key topics that we're going to be focused on, obviously got an incredible lineup. I'd say 3 of my favorite speakers, I have to say, doing the keynotes today. So obviously Greg, there's no one I love more than having involved in our events twice a year to come and give us a rundown on what he's seeing in the property market. There's literally no one that, there's probably very few people in this country that see as much as what Greg has, in his time and experience. It's active in the markets, actively investing, etc. And then likewise, Kate Cooper from OKX Australia, she spoke at I have to say, she made a massive difference to me when she spoke at our AI summit last time. And simple things that she gave the actually entire crowd as far as suggestions around AI I implemented it inside, inside for myself personally and inside my company. So you're going to absolutely love her talk. And, being one of the dominant sort of crypto exchanges on the planet, she has a perspective that, very few people have, and sees where sort of markets are going and what's happening. And obviously it's a question most investors have. And then the third keynote with Ken Shaw. Ken has been, most of you don't know, but behind the scenes, Ken's actually been a bit of a mentor for me when it comes to AI and AI agents, and actually is helping us in what we're building from the agentic layer for Capital HQ. And I just know that any executives and any investors I put him in front of, the fact that he's an actual operator that's built and sold 2 businesses in the US, the perspective he brings is just really pragmatic and actionable. And that's always sort of what we want to bring, when we bring keynotes and speakers to our events. And then of course on the panel session, obviously digital assets have had a rough sort of last 12 months. But the reality is the foundations are still in place. And as I talked about on sort of day 2 yesterday, the institutionalisation of digital assets is taking place at the moment. And there's, obviously there's one big act that's gone through in the Genius Act. The next act that everyone's sort of waiting and sort of going through Congress at the moment is around the Clarity Act. And behind that sits an absolute wall of money, looking to make its way into this space. But at the same time, you've also got the future of finance rails being built, where you're seeing things like stablecoins that are making such a big headway, across the markets. So, said it's for day 3, I said we just could not have jammed it packed with more investor insights, of what you can extract from it. And then obviously on the private equity panel session, Pete, is a favourite sort of amongst you guys, really focused around the ETA side. Nick, actually private credit, just so you guys know, ranked as the 3rd top area of interest for investors. And it just really fits with what everyone's talking about, that barbell strategy where I said people are looking to invest into things which have either high growth, right? Or they're looking to things which have yield and also growth attached to it. And, that really speaks to today, in what we're covering from a topics perspective. And then finishing the day with the family office, and then early today, having the family office panel session, just insights from what other family offices are doing, what they're looking at. So these are some of my favorite people that I get the opportunity to work with and sort of become friends of mine. And I said, they're the ones that I speak to when I've got various questions. So I said, we've done our best to make sure that we bring this home. And then, of course, today we finish with the most important part, which is the networking drinks at the end. So today is going to be a massive day. Obviously, we've got some incredible companies, participating and presenting. Shout out, I'll just give a quick shout out to someone like SWAN Systems, just as an example. You go on their website and you see that they've got irrigation technology. And then you find out that basically their clients are the likes of Microsoft, Google, and all the big AI infrastructure players, because they are utilizing their irrigation systems for their data centers. As an example, Straightcurve, the guy's doing over 20 million of revenue right now, and it's got healthy EBIT and now looking to scale and never raised capital before. Incredible business, incredible operator, and then, one's Canopy Blue, just a very unique approach in the algae area, focusing on biostimulants. Kardinia Energy, now I may stuff this up technically, but I spoke to him a few days ago, and really impressive. If you think about the focus of everyone looking to invest more sovereign, they're doing it with solar panels, because most solar panels actually get imported for China. Well, they've figured out a way to use a recyclable material for the manufacturing process of solar panels, and do it in Australia and do it cheaper than what you can import it from China. So another incredible opportunity. So they're just some examples of the companies that are presenting today. I'm getting the flashing sign saying that my time is up. So again, I just want to say a big thank you to all our sponsors. This stuff doesn't happen without them. And not only are they, sponsors on the contribution to the conference, but they are just incredible people to work with. I said, Kate and the OKX team, we absolutely love them. We love everything about what they do, how they engage with our ecosystem, and how they're helping, high net worths and family offices, get more exposure to the digital assets area, as it's continuously growing. MTP Connect have been amazing. Everyone has just been, I said, I want to go through all of them, but I've run out of time. But yes, a big thank you to everyone that sponsored and supported us. I hope I've done my best in sort of showcasing how powerful this space is, the innovation potential, and also the opportunities that you can get access to investors in this space. So, ladies and gentlemen, I hand you over to day 3 of Emergence, and over to Jade.
Thank you, Steve, and good morning, everyone. Welcome to the final leg of Emergence 2026. It's been an incredible journey over the last 2 days, and today promises to be our most impactful yet. To kick off our keynote series today, we are honored to have a titan of the investment world with us. With a career spanning over 45 years, he is recognized as one of the few inductees into the Australian Property Hall of Fame. He's been a pivotal figure in shaping the nation's property landscape, having co-founded milestone companies such as Growth Equities Mutual, Paladin Australia, and the James Fielding Group, and serving as the CEO of Mirvac Group. Currently the chairman of Left Field Investments, Greg's influence continues to extend far beyond the boardroom. Beyond his commercial success, he was awarded an Officer of the Order of Australia for his distinguished service to the community and his leadership in the not-for-profit sector. Please join me in welcoming Greg Paramor.
Good morning. I think I get a few minutes just to cover the whole of the spectrum of property investment in this great land of ours. It's called speed dating, I think, so we'll get going, and I'll run through it as quickly as I can. I went to a course actually a few years ago after COVID, just to get out of Oz, and took myself up to Oxford and immersed myself in the real estate faculty there for a little while, which was quite telling because the world was a pretty crazy place, if we recall, just a few short years ago. And we weren't quite sure what was going to happen with the pandemic and the post-pandemic and working from home and all these changes that were confronting us. And the topic at that time, and all the experts around the world, had 4 things they were interested in: EDS, education; beds, the living sector in all its forms; sheds, obviously industrial; and meds, medical facilities and or medical science. And I thought, and the things that weren't on the agenda was the office market, the retail market, and industrial/logistics was okay. You couldn't give away offices in the US. You were battling to give them away in London and other places. Retail was overdone, never to ride again. So I came back thinking about that and looked at the Australian landscape and thought, well, I don't quite agree with that in the world, but it's been an interesting journey over this last 3 years just to see how these cycles work and how trends come and go and opportunities come and go. So I'm just going to give you a quick snapshot as to where I see the major markets in our land. So I'll start off with office. Office is certainly bifurcating. Prime and A-grade space is in very short supply in Sydney, in Brisbane, a little less so in Melbourne, but still quite strong. And in the minor markets of Canberra, Adelaide and Perth, which we don't play, and incidentally I'm involved with Charter Hall as well. I'm on their board and chair their investment committee, so we've got about $70 billion worth of property around our land, so I've got a good lens into what we're doing. And the prime space, we're going to run out of it in about 2.5, 3 years' time. And the interesting thing with the office sector now, the cost of construction, which is about 30% higher than it was in 2020, it's actually nearly 40% higher, is making it very hard to get projects to stack up. Coupled with that, with the labour the way it is, we got down in Brisbane to 1.5 days effective work per week, per paid week, 18 months ago. We're now proudly, the builders tell me up there, was finishing a building called 360 Queen Street, and they were pretty happy because they were almost at 3 days per week. And if you think we've got a problem in this country with labour and productivity, we certainly do. Anyway, the office market went down about 30-odd% from 2021 to last year. It's stabilised. It is interest rate sensitive, but the interest rates rises that we're going through now, and I would expect at least another one, I think. It's been factored into most of the numbers, so we've seen the worst of the decline in asset values, and we're now starting to see some green shoots and an improvement in values, mainly led by very strong rents. And as I said, it's really bifurcated into premium and A grade. Suburban office, B and C grade office is in a probably, I'd say, almost a world of pain at this stage, but certainly it's going to be tough in the next few years. Interesting enough, in Melbourne, 75% of the vacancy in office is in the bottom 10% of the properties. So office, as I said, is stabilised. I'm pretty comfortable that it's got a good future. We'll talk about AI in a minute if I've got time, as that will impact it. Retail, shopping centres, they've had, that's split into two. Regional shopping centres, the masthead being mainly Westfield. They've had a pretty tough time over the last decade with the change in retail habits. However, they're coming back quite nicely. The yields on those is around 5, still 5.5% or thereabouts. Neighbourhood centres are in very strong demand from buyers and yielding in the 6s, sometimes 7% range, and with some great opportunities in terms of redevelopment opportunities to add particularly residential to the sites. We're just doing one in the Gordon Centre, just up the road here in Pacific Highway, where we've now got approval, we being Charter Hall, got approval to demolish the Gordon Shopping Centre, which I bought, I think, 25 years ago in one of my guises, and it ended up with Charter Hall. And we're doing major residential development. We won't be doing it ourselves, we're selling it on to somebody who will do that, because we don't actually do residential development. And that'll be build to sell and build to rent. So there's some great opportunities with retail, and the performance of retail is pretty strong. The major retailers, Coles, Woolies, Aldi, etc., their growth pretty much mirrors inflation, so you've got a very good inflation hedge with the majors, and they're all keyed into percentage rents, so you tend to pick that up as you go along. The advent of clicks rather than bricks sort of has settled. You know, with COVID, we thought everyone was going to, shopping centres were going to decline and everyone's going to shop online. And I think it's pretty stable at around 14%, so people do buy online. I'm sure many in this room do. I did it twice, and still, I don't like shopping much anyway, but still go back to the good old go up and down the aisles and think I'll have this or that. So retail's in pretty good shape. Charter Hall, we just raised $3.5 billion from institutional investors to go out and buy a lot of retail, and this week I think we settled about $360 million of acquisitions, with a couple of billion more to come. Logistics, industrial, over the last 5 years, that has been the darling of the sector. That was the one that around the globe everyone was focused on, and it's still being focused on, and you're seeing the very large Amazons of this world developing huge logistics hubs around the world, really, and certainly in this country, in Melbourne, Sydney, Brisbane, on the west coast, and even in South Australia. The vacancy is very low with industrial. It's around 3% across the country. I think it's just under 2% in Sydney, about 4% in Melbourne. And the interesting thing with logistics is you've got to be very careful with obsolescence, because it's all about cubic capacity, not square capacity, in terms of old-style industrial sheds not being high enough. The way that these work now with robotics, they look at the volume in the space, and they can go up 20 metres or more in terms of being able to stack. And of course the big change there is robotics. You can have a major installation with very, very few people actually on site, and that's becoming more and more. The living sector, which covers everything non-commercial, I guess, housing, apartments, hotels, build to rent, co-living, etc. It's interesting, it makes up about $12 trillion of investment in this country is in our housing. And as you read every day, it's unaffordable, and you read every day it's undersupplied, which is both true. With the affordability bit, when Kerry and I bought our first house, it was unaffordable. We were 120% geared. I borrowed from one bank to go to another bank to tell them I actually had some money, which I didn't. And that's pretty true, and that was, 50-something years ago. And it's always been unaffordable. The way and it's not just in Australia, it's pretty much around the world. There are different models, obviously. There's a European model, which is more rental model that came out of the end of World War II, when they desperately needed housing and people needed a job, so they got a unit and they got a job, and that sort of persevered there. In the American market, obviously, it's more build to own, less than ours. I think they're around about 60% home ownership. We're closer to 70%, but coming down a little. And it now takes the average person, I read just recently, about 11 years to save up their 20% deposit, when it used to be about 7 years a little while ago. And of course the median house price now is around Australia is in excess of $1 million per dwelling, which is a pretty big sum when you're 25 or 30 years of age and trying to figure out how to get into the market. Obviously Sydney is the most expensive market, and then it moves around in the various states. The biggest problem with this whole sector, and it does vary state to state, but it's becoming, or has become, quite endemic, unfortunately, is planning rules. Planning rules are incredibly restrictive. A couple of good examples. I invested through a friend of mine. I put some money into a syndicate he had put together 22 years ago in Nowra. Nowra has a housing shortage. It has a desperate need for affordable housing, and we were going to develop 400 lots on this disused golf course. We got the DA 18 years after we started. We had the Greens got into power, and they decided they didn't want anything, and then when they got sort of out, the state changed their mind, so we couldn't get through that. So and the fellow that put it together, my dear friend Richard, he actually passed away just a few years ago. So for God's sake, would you please get this thing done? So we've now got the DA, and we're still trying to tidy up a couple of things, and we do hope that we'll start to do something this year. The interesting thing is that the desperate need is for affordable housing, but they blocked that, and we had to only have 100 lots of at least 2,000 square metres, on the old language, half an acre, which will go to wealthy tradies and other people that do like large blocks of land, we're surrounded by nice bush. We're actually, because the council's changed now and they're saying, well, we desperately need affordable housing, so we're actually going back to them after 22 years and saying, I tell you what, we can actually give you this, and we've got this other scheme here that will give you 300 or 400 lots, and that will make it much more acceptable to the community that are in desperate need of housing. So it's quite amazing. And I could just keep rattling off these things. I mean, a few others in our family area, you just don't even go. One we're doing in Manly, and we just had to wait the time out. The council had no interest in assisting the process, so we're going straight to the Land and Environment Court. How long will that take us? Or about another year. And all these things are just stopping it. On the fringe of the city, where there is so-called affordable lots and much where people are going, you have releases of land that can't be serviced because the water board can't get there to put the water on. So there's one that I think it's got 5,000 lots, and the water board said we can let you kick off with 500 lots because we can't get the services to you for another 3 years. So we've got this huge bottleneck and confusion around that. I must say the Minns government is having a good go at doing something here. The Victorian government, such as it is in absolute disarray, so it's going backwards at the rate of knots. It used to have very good planning. Queensland used to have very good planning. It got messed about by the last government. It's changing back to being quite efficient now. So the living sector, we've got a severe undersupply. The current government, when in the first round, said we want to build 1.2 million houses over 5 years. And the question was, is that an additional 1.2 million houses, or is that the normal 1.2 million houses that we normally build over 5 years? They've never answered that, but I think it's the latter. But they're going to miss it by 400,000 at this stage. So that need is there, and we're still going to miss it by about 400,000 units of housing throughout Australia. It varies from state to state, of course. The build-to-rent sector, you might have heard and read and participated in it. And that's something we've imported from the US mainly, and of course you do have large rental opportunities, particularly in the UK. As I said, Europe's a little different, as is Asia. But the build-to-rent sector really hasn't got off the ground, I don't think, in Australia the way that it was intended, because the US model is cheap housing, very much focused on where people are working, and they've got a very transient population that will follow industries around. And they have very generous municipality, state and federal tax breaks for building these sorts of housing, which we don't. Indeed, the government's making it even harder for foreigners to come in and actually participate in our market, because we have large institutional investors that do want to invest in this space, particularly coming out of Japan and parts of Europe, particularly the Netherlands. So that will keep going. The essential worker housing is the term I like to use rather than affordable housing. There are plans around that, and I've participated in a couple of those, and that is where you get a discount, you discount the rent to suit, to make it more affordable. For instance, Westmead Hospital Precinct out towards Parramatta, there's quite a lot of essential worker housing in that region, which has just been a fantastic boon to particularly medical nurses and sisters and young doctors and orderlies, etc., etc. One little thing we had just recently, one of the properties we have out there, these two nurses moved into a two-bedroom, and they used to commute about 3 hours a day to get to and from work, and they could get another shift in because they weren't commuting 3 hours a day, so they were doing 2 shifts a day, saving money. And all of a sudden, they weren't essential, they were above the threshold, so they couldn't live there anymore because they were actually saving money. And of course, they were saving money because they wanted to go and buy a house. So you get this little circle. And interestingly enough, when we took that to government, they actually changed the rules and said that's a good idea, so they can stay there. And, you know, it's a fantastic boon for people to be able to to save up money for either housing or some other thing that they wish to do. Just quickly, because my time's up, I'm told. Data centres, you would have heard a lot about data centres, and they're really interesting. Be very careful if you're investing in them, who you're investing with. Goodman here are into that, and Goodman are a terrific organisation that I think will succeed in what they're doing, but there's going to be real winners and losers in this whole, and you're talking a lot, Steve, about data and the new world. And of course, these data centres have an enormous drag on energy, they have an enormous drag on water and everything else. The big issue I have with it, and colleagues of mine have, is it's very hard to figure out the terminal value on these things because it's not a traditional type of, it's just a big box with a lot of energy. And particular chips, and those chips are changing all the time, and the hyperscalers, as they're called, are domineering that around the world, and you just got to be very careful where you go with that. It is obviously going to be a big feature because you've got to have these things, otherwise you fall behind the rest of the world. And that is still, I don't think, being properly addressed at the government levels throughout Australia because it's such a big change. Just very quickly, tax and productivity. You would have been reading about the CFMEU, and I've mentioned something about that just a little while ago. We have a real productivity issue in Australia, not just real estate, but that's one of them, just trying to get labour to build these things. And I told you earlier that costs have gone up sort of 40%. They're rising at almost double inflation per annum. And that's going to put a big squeeze on new development, which is going to mean we're going to be generally an undersupplied market pretty much across everything in the next few years as I see it. There's a couple of outliers there that may change it, AI being one of them, artificial intelligence. A lot of I won't call it menial, but a lot of productivity in an office where you've had people processing things. They might be junior lawyers, they might be junior accountants, they might be junior fund managers, are being and are going to be replaced a lot with AI. What that's actually going to do to our workforce is very hard to actually put a marker on. There'll be winners, there'll be losers, there'll be, and if you've got kids, what should they be doing to try and protect themselves when they do get qualified and whatever they're doing, that they will have a job for a reasonable period of time. I think, I'm an optimist, so I think AI will be a boon for us, but we're going through a huge transition, just like we did with the Industrial Revolution, I guess from the agrarian to the industrial to the post-industrial era. There were big dislocations as factories became more sophisticated and you didn't need the same labour force, and that's been with us for centuries. So that's something that takes up a lot of my time thinking, how is that going to play out? Working from home, which was all the rage back in 2020, I don't think people really want to work from home. They do. A lot of people don't work in an office anyway. They're in service industries, they're in retailing, they're doing all sorts of things. So it's only a very small section of the workforce really that occupy office space, and that's the work from home bit. And a lot of people can work from home and very successfully work from home and did so before COVID and are doing so now. And we're seeing a big drift back to the cities. And the main reason being, if you're not there, how do you learn? If a young person's not, if you're on a screen, how do you really learn from the person sitting next to you? Say, don't do it that way, do it this way. So once again, I think that's sort of come and gone a little bit, except in Victoria, because the Premier there reckons she's going to mandate that everybody can work from home. Isn't that a jolly thing? Well, no person works in Victoria. Any Victorians in the room? There's a very, very low productivity in that place. Anyway, I've taken up enough time. I'd love to rattle on for a long period of time, but my time's up. Thank you. Have a good day.
And that was Greg Paramor. Thank you for sharing with us your expert insights and forecasts. Our first company presentation of the day comes from one of our key sponsors, OKX. As one of the world's largest and most trusted cryptocurrency exchanges, OKX is at the forefront of the digital asset revolution. Serving millions of users across 100 countries, they have transitioned from a high-volume trading platform into a full-stack Web3 ecosystem, offering everything from secure institutional custody and advanced DeFi tools to their own multi-chain wallet. To share more about how they are bridging the gap between traditional finance and the on-chain economy, please welcome its CEO, Kate Cooper.
Good morning, everyone. Get those at the right level. My name is Kate Cooper. I'm CEO of OKX Australia. And I'm speaking without slides today because the story I'm going to be telling you this morning isn't really a story about charts. It's an architecture story. And architecture determines who captures value long before the markets price it. We've heard already, most people are asking right now a simple question, is the bull market over? Is the crypto run over? Prices have fallen, we've seen volatility coming back, confidence feels like it's been waning. And it's a fair question, but it's the wrong frame, in my opinion. Markets are cyclical, architecture is structural. And what we're witnessing now is infrastructure embedding beneath volatility. I'm sure many of you are familiar with the S-curve and know that every transformative system follows an S-curve. In the early phase, it feels chaotic, speculative, unstable, and that's very much been crypto over the last 10 years. But then, in the S-curve, infrastructure begins to form. You get standards, custody, compliance, institutional participation. And that's, for me, where stablecoins are right now. At the same time, the hype buzzword of the year, AI, is entering acceleration. And what's really interesting for me is that this year, in 2026, 3 S-curves are converging. You've got digital assets, you've got stablecoins, and you've got AI-enabled commerce. And when S-curves intersect, systems don't move incrementally. They completely re-architect. And that's what I want to talk to you about today. A few weeks ago, I was lucky enough to be guest of MasterCard at the Australian Open. We were on centre court, there was lots of noise, as you'd expect, sponsors everywhere. But inside one of the side buildings off Rod Laver Arena, something quiet happened that a lot of people missed. Australia's first fully authenticated agentic transaction on a global card network. It was a CommBank debit card that purchased cinema tickets at event cinemas, but no human clicked confirm. An AI agent did. Fully authorised with cardholder consent, recognised by the issuer, by the acquirer, by the merchant. The agent was visible, governed, authenticated. And then there was a second transaction which used a Westpac credit card to book accommodation in Thredbo. Different bank, different merchant, but the same governed framework. The transactions were powered by MainCode's sovereign Australian large language model called Matilda. So we had an Australian LLM, Australian banks, global payment rails, authenticated AI agents. That for me is not experimentation. That's infrastructure embedding in real time. And once machines transact, programmable money is no longer optional, it becomes foundational. It's one of the main reasons why I commissioned the Economic Impact of Digital Finance report. It wasn't about validating an asset class, it was to quantify the infrastructure impact. The first tranche we released last June at the Digital Economy Council of Australia's annual conference, and we estimated that digital finance can unlock approximately $19 billion in productivity gains in Australia per annum, which is the equivalent to 1% of the GDP. So if we say, as Greg said, we've got a serious productivity problem, actually digital finance represents one of the big opportunities. And it's not about token prices. It's not about that market volatility. It's much more a productivity from faster settlements, reducing cross-border friction, from tokenized capital markets, from lower reconciliation and intermediation costs. The final report's going to be released in a couple of weeks, and it shows that the number is even larger than the initial number that we had last year. But there's a problem. There's a gap. Based on our current trajectory, we're only on track to capture about $1.8 billion of that productivity opportunity. And the gap isn't around sentiment, it's about infrastructure readiness, policy settings, custody standards, settlement rails. If you'd like to get a copy of the full report as soon as it lands, head over to the OKX stands and scan a QR code, and we'll make sure you get a copy on the 3rd of March. For a moment, I'm going to zoom out. And I don't know how many of you were following the World Economic Forum last month, but one of my favourite quotes was from Mark Carney. And he said, middle powers must act together because if we're not at the table, we're on the menu. And for me, this is where digital finance is there. It's not rhetorical, it's actual. If Australia does not embed AUD-denominated programmable money into global digital rails, we risk ceding monetary influence to other sovereign systems. If USD stablecoins dominate programmable settlement, liquidity defaults to USD infrastructure. If AI agents, like the one MasterCard used, transact in foreign-denominated rails, monetary gravity shifts quietly. There won't be a big announcement, there won't be a crisis headline in the AFR. It's just architecture quietly doing its work. And for a middle power like Australia, sovereignty is expressed through infrastructure. Last week I was in Canberra, and it was a fairly pivotal week in our industry because we were together at Parliament House designing an Australian strategic digital asset reserve. Not a speculative vehicle, it's a sovereign defensive capability. It begins with assets already under government control. It builds sovereign-grade custody inside Australia. It instills audit discipline and reporting transparency. It treats regulated AUD stablecoins as a settlement instrument. It treats Bitcoin distinctly because liquidity, neutrality and resilience. It's phased, it's rule-bound, it's governance first, because sovereignty without custody is theatre. And it's the reason why I left my banking career to lead OKX in Australia. I very actively chose OKX because I really believe that if this architecture is going to scale safely, we need serious infrastructure nodes, which requires serious investment from a global player. Custody, liquidity, compliance, on-ramp settlement rails. At OKX, we're about to list regulated AUD stablecoins. We're launching integrated pay and card infrastructure. We're connecting digital assets to everyday financial rails, not because it's fashionable, but because the architecture is shifting. So for those of you in the room who are allocating capital, for me, this is the real questions you want to be asking. Not are you trading volatility? Are you allocating to infrastructure? Are you exposed to programmable settlement growth? And are you pricing sovereignty risk? Because capital flows to jurisdictions that shape the rails. I recently released my first book called Edge, And EDGE is a field guide to operating when technology changes faster than we as human beings do. And one of the core analogies in the book is edge computing. And in edge computing, intelligence moves faster to where data is generated in order to reduce latency. Digital finance is doing the same with capital, reducing latency, reducing friction, reducing dependency. The investors and the countries that win this decade, in my opinion, will not be those who perfectly time the cycles. It will be those who recognise those structural shifts early and move. Cycles create noise, infrastructure creates power. Thank you.
Thanks, Kate. Continuing with our sponsors, our next presenter is changing the way we'll look at business transitions and capital. In the face of what many call the great tsunami of retiring SME owners, Valloop Australia has launched Australia's first complete ecosystem for employee-owned business succession. To tell us more about it, please welcome Giles Carhan, Director of Valloop Australia.
Hi everyone. I've been up here a few times on a few different things. So Steve and I have worked together for a long, long time. And actually at this conference, I think it was 2 years ago, I met the founder of Valloop. I did some consulting and then I invested, and now I do Australia and New Zealand and potentially other jurisdictions. So it really, I believe it shows the absolute value that Steve provides to everyone. Now, we're not looking to raise any money. We're not looking for any sort of investment. We're just looking for people who know people who want to retire. That's all we need. Our product really, I do have a presentation here. I'm not going to go through it too much, or rather just talk about it. We provide an exit to founders, a guaranteed exit that they will get paid over a period of time. So my father was one of these men who built businesses, ended up having to sell it to a competitor because he couldn't sell it to anyone else, basically for the value of spare parts. And that was because the two guys that he had, these two senior sort of leaders within his company, couldn't afford to buy him out. They couldn't raise the money because they had mortgages, they had everything, and they had other responsibilities that they weren't able to go to a bank, raise the money to buy the business. So what we provide is an opportunity for senior leaders or external people coming in to buy a business, to take over that business without personal guarantees, without huge capital, because we back them to keep that business going, to pay off what is called a deferred consideration, so it's a deferred payment to the owner, over a period of time. So if you think about that, anyone in this room can go buy a business and the vendor knows that they're going to get paid. Might be delayed, but they are going to get paid. Now we have, I'll get to that in a second actually, I'll come back to it. So it's if anyone knows what vendor finance is, anyone has been involved in vendor finance, we guarantee it. We've got £39 billion worth of insurance. Now, so it's £39 billion worth of insurance. Berkshire Hathaway, Mitsui, Lloyd's are just a few who provide that insurance across it, because this is a global problem. So NAB came out with a report. They estimate it's 350,000 businesses in Australia, 1.8 trillion need to transition in the next 10 years. That's Australia. Wait till you get to the US, Japan, China. Everywhere this is a global social issue that governments need to look at and need to understand. If you look at any ESG commentator out there, they've all done stories on this. And I guess the beauty of our product is we don't have investors. So we're not looking for capital return to investors. That means we don't need businesses that are going to do 30 IRRs and have great returns to investors. We want stable businesses. We whilst I've worked in financial services for a long time, and they always say, past performance is not an indicator of future performance. We look at it the other way. Past performance is an indicator of future performances. That's the way we've got to look at it. And look, we're not looking to do this on a deal here and a deal there. We want to be doing over 100 in Australia a year. Those names I just rattled off, this is nothing. 80 billion Aussie dollars is nothing to them. They see the need for this, and I personally do as well. Now we have quite a streamlined process. We can go into all that, but really what we're offering to vendors is the ability to exit. Now, if you want to ask what's the biggest issue at this point in time, private credit. Private credit is the issue because acquisition finance is very difficult in this country. The fact that the money goes out day one. So we're working with a lot of different private credit providers, and also that leads into the next problem, which is CGT. It's a guaranteed product, so CGT's due day one. But getting through that and working with a number of capital credit providers, we're getting through those, and we've got 9 deals in the pipeline at the moment, and this is my marketing for this year at this point in time. We're not doing any marketing. We're not out there soliciting businesses because there are so many that come to us on a daily basis. So anyone in the room here who knows someone who wants to retire, we are an option. And also, I think we've probably got private equity firms here, tail end of funds, assets that they can't get rid of. Obviously, we're an option there. And it's not just people wanting to retire, it's people wanting to purchase businesses. We're doing a roll-up strategy of 4 electrical services businesses in southeast Queensland at the moment. I would love to get into the small cap listed space. There are a whole lot of equities in there that shouldn't be listed. It's $1 million to be on the ASX. They should be privatised. They're doing 2 times EBIT. They've got no real blue sky, and they're going to trade down for the next 5 years until probably they'll take themselves off the market. Look, this is just an example. I'm happy to talk to anyone, explain what we do. It seems quite complicated, and I've worked in financial services for a long time. I found it difficult at the start, but once you actually understand how it works, it's actually not. The one thing you need is someone who wants to sell and is willing to take a smaller amount up front, but a guaranteed payment over a period of time, generally 5 years. Now, if you sell to private equity, well, good on you if you can, but that's on a 70-30, 60-40 split with performance on the tail end of the 30 and 40. And I can tell you they find a lot of ways not to pay it. So at least we guarantee that payment. But also, as I said, we don't have investors, so we're not looking for these huge growth potentials. So yeah, everyone in the room, if you know of anyone who wants to retire, you know of anyone who's looking to buy a business, just my details will be somewhere, I'm sure. Sorry. There. No, I'm back. And my details are at the end. Please send them our way. Look, as I've always said, these are great conferences, so I hope you enjoy the last day, and I no doubt we'll see you at the next one. Thanks, everyone.
Giles. Next, we have BetterX, a company dedicated to building the bridge between traditional finance and the digital asset economy. Their mission is to empower wealth advisors, OTC desks, and trading teams with secure, compliant digital asset solutions that are remarkably easy to launch, manage, and scale. To share more about their institutional-grade platform, please welcome their COO, Eric Chow.
Morning, everyone. Actually, just want to thank Kate. Firstly, she framed a lot of what I'll be speaking about with regards to infrastructure and also stablecoins as well. So I just want to start by saying Most of the world's wealth at the moment is held by family offices, institutions, and advisors. And in the coming 10 years, the majority of digital assets will be traded from this segment because they hold the majority of the world's wealth in trillions of dollars. They want exposure to digital assets, but infrastructure they're given at the moment forces them to choose between speed, compliance, and controls. BetterX exists because these shouldn't exist. I'm Eric Chow, co-founder and COO of BetterX. We build infrastructure and let businesses operate regulated digital asset services without becoming an exchange, custodian, or tech company themselves. At the moment, there's three main challenges when entering into digital assets as a business. You've got fragmented tooling across trading, execution, and custody. You need to navigate through the regulatory compliance and also understand what's required. And then thirdly, loss of client ownership and relationships to exchanges and brokers as well. At BetterX, we've built an ecosystem that sits on three pillars: a trading platform, a RWA engine, and also have a Australian stablecoin that's live on a global exchange as well. The first pillar of the BetterX product, we allow our B2B partners to provide trading, permissioned workflows, infrastructure, management, reporting, and liquidity through our partnerships so that they can actually trade and oversee their clients' trading activities on exchanges and also on our platform as well. The second pillar of our business is our Australian stablecoin. So Kate touched on it previously, but programmable money and how it's so important in the coming future. Currently, we're live on Kraken Global and SwiftX, and we're in the process of being listed onto many more other global exchanges. But how does this tie into our ecosystem? We've always been of the thesis that as digital assets are adopted in the real world, more and more businesses, family offices, advisors will start trading real world assets, which are RWAs. And to trade RWAs effectively, you need a stablecoin, which is programmable money, to move it on the blockchain. So that's where our ecosystem comes into play with our trading platform to be able to list the RWAs and tokens, giving our users a username, password, MFA to be able to log in and to transact, and then having our stablecoin, which will then power the entire ecosystem at an institutional level. We're live and we're growing. Since going live around 2 years ago, we've saved our end clients thousands of customers. We've helped them retain millions, actually hundreds, actually nearly billions of trading volume, and retain millions of dollars in their own fees themselves, opposed to being bled out to brokers. And we saw recently with a crypto broker that recently got sold for $100 million in Australia. It's the clients that have been referred to the brokers, which have then effectively enabled the business to be sold for large amounts. So we're really giving the power back to our B2B partners, which are businesses, advisors, family offices, who have several fund managers as well, to be able to allow their clients to access our platform to trade compliantly and oversee their clients' portfolios as well. We operate in Australia through Austrac and ASIC. We also have a partner in Singapore as well, who operates under an MPR license that uses our technology only at BetterX. We actually started developing the platform from 2021. Today, we're live. We've got about 20 B2B partners on the platform. And on the Aussie Stablecoin project, we've got 2 exchanges at the moment. Our team, we've built for some of the world's largest banks. My CTO and co-founder, Adam, used to be the head of data and AI at DBS. Prior to that, he was at HSBC and built their live treasury system. My other co-founder, Kinsey, co-founded a business called Tibra Capital, which is a high-frequency trading market-making firm with over $1 billion in their prop book. And my other co-founder, Calvin, co-founded a business called Aura Group, which is a traditional funds management business. And through that journey, he actually built another business called Finsure, which about 3 years ago exited for $152 million. So combining our skills together from traditional finance, we're building the infrastructure and also ecosystem for the next layer of participants to enter into digital assets. We are looking for strategic investment at the moment to scale our product and take it global. So would love to catch up and speak to anyone. We've got a stand at the front. Thank you for attending. Cheers.
Thanks, Eric. Next, let's welcome Canopy Blue. They are pioneering a shift in environmental restoration by transforming native seaweed into sustainable nature-positive solutions. To discuss their mission further, please welcome their Executive Director, James McGlue.
Good morning. As serious investors, you're here to make your money work hard and outperform. This is the perfect forum to find that deep value and growth from companies, from new industries and offering IP. And if you can achieve this while also delivering social economic outcomes and equity and help solve significant climate problems, you're really starting to make your money work hard. How do we move this on? There we go. Agriculture and food security that it delivers faces a serious existential threat from climate change and the global addiction to synthetic fertilisers such as urea and nitrogen, particularly here in Australia. Arable land is diminishing, drought, salinity and stress on animals threaten productivity and sustainability. And this is one of several problems that we address. Canopy Blue is an Australian regenerative seaweed company, and our early commercial focus is on delivering premium farmed kelp feedstock for the rapidly expanding but supply constrained soil biostimulant and animal supplement markets. Importantly, we have a really experienced management team that have a demonstrable ability to execute and deliver. And that's across all of the space that we work in: aquaculture, agriculture, corporate, carbon markets, and most importantly, seaweed farming. And we tick a lot of boxes. We don't take this lightly. Nature has a cost. This macroeconomic theme is a seismic change for the global economy. Nature is now on your balance sheet, and new industries must be regenerative and not extractive. Canopy Blue is built on three core pillars. One, commercial. We will be delivering strong shareholder returns and early revenue from our biostimulant and animal supplement products. And our circular economy model enables us co-located processing and value add at the sites that we work. Social economic equity. Through a landmark equity and strategic partnership with the Kimberley Land Council and traditional owners, we're going to deliver long-term intergenerational economic benefits to the communities on whose land and water we are privileged to operate. And third, climate. Our operations will provide positive, measurable, long-term climate impacts, supporting marine ecosystem restoration and improving soil health on land. We're already contributing to the biodiversity recovery in the ocean with our kelp reforestation program at Kalbarri. Nearly 200,000 hectares of kelp beds were wiped out by a marine heat event in 2014. The 5% that survived were obviously the ones of interest. Through this program and working with the University of Western Australia, we've delivered the world's first stapled kelp reforestation credits. We've sold over $1.2 million of them, most of them to leading fishing company Austral Fisheries to offset their carbon obligations with a strong narrative. We have a compelling video on this. It's available in our data room for you to watch. And as with all of our work, this is driven by science, data and outcomes. The last 3 years have seen Canopy make substantial progress. We've aggregated 4 geographically spread projects across the 8,500 kilometre coastline of Western Australia. And this covers in excess of 6,000 hectares, prime, pristine waters. This is pretty much unachievable anywhere else in Australia. At Esperance, or Kepper Curl, this is our southern hub. We have nearly 960 hectares down there, We are just finalising the purchase of those leases, which we'll then have for a 21 plus 21 years. This is our most advanced project, with 2 kelp trials completed and planning underway for our first low capex modular processing plant. Large broadacre farms are on our doorstep, as well as in excess of 50,000 head of cattle. At Cone Bay, or Yalloon, which is about 200 kilometres north of Broome, we have access to nearly 2,000 hectares initially in this region, rich with its aquaculture history of pearling and barramundi farming, which I actually financed Cone Bay barramundi from its inception to sale for 70 million to Commonwealth Capital out of Singapore. Then at Dampier, in the Dampier archipelago, we have nearly 2,000 hectares as well, with our aquaculture partner Maxima Opportunity. We're on the doorstep of some of the world's biggest carbon emitters, and our initial focus here is going to be on bioprospecting. At the Abrolhos Islands, some of the most pristine, nutrient, water-rich waters on the planet, we have nearly 800 hectares and home to 150 unique species of seaweed. The Kimberley Land Council is one of Australia's peak Indigenous bodies. Based in Broome, the gateway to the vast Kimberley region of WA and the Buccaneer Archipelago. It's the size of California, about 423,000 square kilometres, and it's only home to 35,000 people, half of whom are Indigenous. It's also home to 600,000 head of cattle, and under the KLC's management, West Australia's largest horticultural project. So we have that addressable market on our doorstep. This agreement with the KLC will lead us to being the vehicle for a new aquaculture industry that will employ up there. It's a unique opportunity in some of the most amazing waters in the world. And look, these guys are commercial. They're overseeing one of the world's largest solar/hydrogen projects for green hydrogen up at Kununurra. Nearly 2,000 hectares of solar is going in there. They manage cattle, they've got horticulture. So for Canopy Blue, we now have a social licence and access to 65,000 years of traditional knowledge. We've made a lot of progress. Another point that I'd like to highlight is the South 32 soil shift challenge. South 32 is one of the world's biggest miners. They've got these massive open cut mines in the foothills of Perth with Alcoa, where they've been bulldozing thousands of hectares of old growth jarrah forest. What they realised is that mine site rehabilitation isn't going to work with synthetic fertilisers. You have to have a nature-based solution to regrow native flora. This is a global problem. In Australia, we've dug a hell of a lot of holes, and I've actually paid for a few of them as an investment banker over the last 30 years. All of the above have created a really significant moat around this company. The access to the water, the social licence, the offtakes that we'll go through in a moment, and the first mover advantage that we have in this sector provide the basis for what will be a very valuable company. The global biostimulant market is estimated at about $4.5 billion and growing. In Australia, it's 200 million, and it's going to be a multiple of that over the next 5 years. The problem in Australia is that the only feedstock for seaweed for businesses making biostim is beach cast or collected seaweed out of Tasmania or King Island. There was a little bit from New South Wales previously. That runs out quickly, it's highly variable with its efficacy, and the gap is filled by incredibly expensive imports out of Europe, upwards of $18,000 to $20,000 US a tonne. The real opportunity here is not only supplying that market, but also capturing part of that $4.5 billion that we spend on synthetic fertilisers. This is, and in fact, dominated by urea. And the animal supplement market for our cattle is also very important. Sorry, I'm running out of time here. We've got offtakes. It's all there in our data room and with our deck, and the market opportunity is substantial. This is a really exciting part of the business, the bioprospecting. We've got nearly 500 unique species of seaweed to prosecute over there, and we're working with a leading nature AI company out of California, Brightseed. I mean, the reality is that the next blockbuster for oncology might actually come from a red seaweed in Australia. The carbon credit market, we don't overplay this hand. The business has to stand on its own 2 feet as an operating business. But when you overlay carbon credits into this, you get, cream on the cake, and it's significant cream on the cake. I'd just like to highlight how efficient kelp is at sequestering carbon, up to 20 times the rate of terrestrial-based forests. And the modelling that we've used is incredibly conservative, $30 to $60 an ACCU, whereas the blue economy credits, and the buyers of this include Amazon, Apple, Microsoft, are paying upwards of $500. So we've got multiple revenue streams, that de-risks the business. The other thing I'd really like to point out here is that the West Australian government will match us dollar for dollar to $5 million as co-funding, and then there are a hell of a lot of other grants that are available to us. So look, it's an ambitious project, but we've got a timeline of getting this thing to market, to the ASX, within 24 months. We've already seen a number of companies such as Sea Forest trading at about a $200 million market cap. Our ask is $16 million. There's compelling value at this price. And if we get it right, we're going to be worth more, a lot more than $200 million. I'm sorry, I went over the offer slide. We have a deck available for you. It's a very straightforward raise. So in conclusion, wealth's going to flow to those who could regenerate. It's as simple as that. And seaweed farming, we believe, is a fantastic vehicle, not only to deliver that, but to deliver returns to you as shareholders. Thank you very much.
Thanks, James. Closing out this morning block, we have SWAN Systems. They have developed a unified irrigation platform that integrates with existing hardware to provide automated scheduling and precise water optimization. Please welcome their CEO, Tim Hyde.
Sorry about that. I got a bit caught. Welcome everyone. Thanks for being here. Thanks to Steve and the team at Wholesale Investor. My name's Tim Hyde. I'm the CEO and a co-founder of SWAN Systems. We're based in Australia, but we work in 11 countries around the world. So, which button is this? Big green one? There we go. So, a lot of climate technology, a lot of climate change, the conversation's been around carbon for a long time, but it's actually water that gets disrupted first. You look at droughts, rainfall. I know in Sydney here they've had 3 years of above average rainfall. So, the volatility of climate change is actually occurring now, but it's actually occurring very localised. So, our millennial drought in Australia in the 2000s and what's happening in California now, it's pretty significant. So not a lot of people know that agriculture uses 70% of the water, the fresh water in the world to grow food and fibre. So, and with the advent of, data centres has been mentioned a few times today, advent of the data centre boom and the AI boom, it's actually becoming competitive for water in a lot of places, and I'm not quite sure, it's made the papers a few times recently, but if they build the data centres in Sydney that they're proposing, it's going to use 20% of Sydney's water. So it's about 100 gigalitres of water per year, which is a whole lot. So, it's happening in front of us. When they build a data centre with water, it's more efficient, it's more capital efficient, and essentially they use it to cool. So the water's gone. So what is SWAN Systems? So we're software as a service. We work with irrigators. So when someone's, whether it's a municipality or a farmer, we've got 140 collectors. So we collect data. So we're a little bit like an SAP for water management. We collect the data, we analyse it, we make recommendations based on a specific case, whether it's an oval or whether it's a patch of almonds or wine grapes, and then we push it back into the controller. So the pushing it back into the controllers is sort of matching up the agronomic piece with the operational piece, and that's something that we've been working on for a while. And we're the only ones in the world that do it, and our strategy is to become the universal underlying platform for water management, and no one else has done it. Some companies would cross over, have their own software, but no one's done a completely universal system like we have, and it's taken a fair bit of time and effort, but we work with most of the major irrigation companies in the world as a result. Attraction. So corporate farming has been our bread and butter for a long time. We deal with some of the who's who in terms of corporate farming in Australia, North America, in Europe. Basically for our growers, we try to make them more productive, more profitable and sustainable. The wine grape industry is a good choice. They've got a customer-focused demographic, and so we work with a lot of the wine grape companies in Australia. More recently, a thing called water stewardship. So Microsoft approached us probably 18 months ago now. So the tech companies have got a mandate to be water, carbon and power positive. So they want to replace the amount of water, power and carbon that they produce. They did most of those sort of promises in about 2020, 2022. So they want to meet those goals by 2030. There's been a lot of water stewardship projects. We've done work with Coca-Cola in the Philippines and Pepsi in South Australia. So it's not a new concept, but what they've done differently is it's basically an offset program. What they've done differently is water's very local, so you can plant a tree for carbon in Africa and get the benefits in Australia. But with water, it's very local. So we work in Sydney here with Microsoft, Google, and talking to Amazon. So we work with municipalities, Penrith, Hornsby, Wallara, and we help them sort of save water, and that goes to the internal sort of balance sheet of the technology company. So it's a new opportunity, and that's one. So we just won our first project in the Midwest in the US. We've got projects under review in Europe and Australia and North America. So we are the ultimate solution, and the reason is that we can work with any type of irrigation. So whether it's a corporate farm, whether it's an almond farm or alfalfa, Lucerne down in Southern California, we can work with any type of irrigation. We can work with any sort of customer base, whether it's a school or municipality or farmer, and we're audit worthy. So we will source projects, we manage them, and we implement them, and we do the reporting piece for the technology company. So it's a whole sort of bit of an MRV sort of philosophy with the technology companies. Business model, so we are software as a solution. We're 10 years old this year. We spent the first 3 or 4 years building out the solution after we did a big project for Rio Tinto in the early sort of 2010s. We're currently doing our Series A. We've got 2 co-leads. We've got a water PE guy from a company from Houston, and we've got Pure Terra Ventures out of Europe, which is backed by the European Union. So they're our 2 lead investors, and we've got a tail on that round we're doing now. I guess what's different about us is we're just software, so we don't do hardware. The irrigation market's quite fragmented. There's a lot of different hardware offers, a lot of different IoT, so we're recurring revenue. We've got low churn and good margins on our 70% margins on our software costs. So we're positioned for growth. As I mentioned, we work in 11 countries now, so we're pretty busy sort of getting established in some new countries. Thank you.
Thanks, Tim. It's now time for our morning break. So while you're networking, I'd like to invite you all to join our digital community by subscribing to the Capital HQ YouTube channel featuring capital raising masterclass, AI insights, and the latest trends in global private markets. Enjoy the break, and we'll see you back here at 10:55 a.m. sharp for our private equity panel. Thank you. Welcome back, everyone. I hope you all had a productive networking break. We are diving straight into the deep end with our private equity investment trends panel. Our experts are ready to dissect where the smart money is moving in 2026. Please welcome our panelists to the stage. Let's start with our moderator, Lel Smits, Managing Director at the Stock Network. Our panelists, Nick Kelly, Portfolio Manager at WAM Alternative Assets, Pete Seligman, a Search Investor at PAS, Sean Bassett, Partner at Pilab Capital, and Darren Reed, Partner in Sales and Distribution at Prime Financial Group. Let's all welcome them on stage.
Great, we are all now in order as well. So thrilled to be on stage today with some wonderful experts who truly are experts in very specific areas of the investment landscape. And we will be discussing private equity investment trends. I'd like to start by introducing everyone to you and giving you a very brief background where everyone's from to really frame where their answers will come from. So firstly, here we have Nick. Nick is a portfolio manager at WAM Alternative Assets, the only listed investment company on the ASX that offers investors access to a diversified portfolio of alternative assets, typically that are accessible only to institutional investors. Next, we have Pete from ETA Investor that help aspiring business owners find good businesses and give them a great future through acquisition growth and successful exit of small, medium enterprises. Then Sean from Pilab Capital. Pilab is a serial acquirer, acquiring small to medium businesses and holding them permanently. And finally, Darren Reed, Partner Sales and Distribution from Prime Financial Group. Darren has more than 20 years in buy-side investing across hedge funds and family offices and now focuses exclusively on sports and entertainment assets, backing the thesis that Australian and Asia-Pacific sports and entertainment assets are at the same inflection point that US was a year ago. So as you can see, we've got some diverse backgrounds. And with that, I thought we'd open up with a rapid fire question to get to know everyone and their viewpoints very quickly early on. So in one sentence, if I could ask you, one or two sentences, I'll be lenient to ask you, when you think about private equity today, what excites you most about where we are now and also in terms of opportunities, Nick?
Yeah, sure. Thanks, Lel, and great to be here with everyone. All right, two sentences. This is tough. I would say, firstly, just the amount of opportunity, particularly in growth private equity, with obviously the ageing demographic. We've got founders looking to hand over businesses. Next generation don't necessarily want to take them on, and so looking for an exit. And so we're seeing a huge amount of opportunities in that space in particular at the moment.
Excellent, thank you. And how about yourself, Pete?
I'll segue off the back of that to say the exciting part of that dynamic is the opportunity to back new entrepreneurs as the owners that are going to take over from those retiring founders. So the ability to not just back a business, but back an entrepreneur into a business.
How about yourself, Sean?
I'm excited by what Darren does. Sports entertainment sounds like a great area to be playing in. But similar to these guys, we set up our business, started doing what we're doing 6 years ago to take advantage of that huge generational shift of wealth and businesses being passed down from the baby boomers. So that's what excites me because we're in the thick of it now and I think there's a good tale of it.
Wonderful. And Darren, sports and investing, why is that exciting?
I think to go back to your question, what excites me about the entire space is that private equity used to be something that happened over there. It was big banks, big institutions, you read about big deals in the AFR, but now what's happening is that private equity is starting to enter parts of our lives, like your mum or dad who's had a business for 30 or 40 years and is now transitioning that business to private equity, or your favorite sporting team that is being assisted with capital and expertise by private equity. And so you're seeing a transition where this world is now starting to enter the everyday lives of people. It's becoming real life. It's not just something that happened that other people do. It's something we can actually all participate in.
Absolutely. So that really brings us to our first theme, which is the democratization of private equity and how everyday people are able to access these assets that they may not have been able to in the past. I think, Darren, as a segue, it would be good to ask you because as we introduced you, you said that sports now in Australia is where it was 10 years ago for the US. How are you seeing the democratization of this area in your focus?
Yeah, so I think what's happened, and I don't profess to be the smartest guy in the room, I think we're early, and really we're just following the playbook that the US has shown us. And what happened there was that I think two main things of why sport has moved from what used to be essentially a hobby or trophy asset for billionaires who didn't know what else to do with their money into a proper institutional asset class. And the two main things are, I think people realized the uniqueness of the content and the IP that they actually own. So to give you a very simple example, if you take the amount of viewing time that's available across a week, 24/7, across linear television, your streamers, Amazon, Netflix, etc., live sport makes up about 3% of that total time available. But of the total viewing time, so what people actually watch, sport is about over 40% of that. So 3% of your content accounts for 40% of your live viewership. People have realized that sport is the last type of content that we have to watch live. We watch it together. We watch it at scale. I mean, if you think of COVID when we were all locked in our houses, what did we deem as essential services? We said Coles and Woolies have to stay open, the police have to stay on the streets, the hospitals have to stay open, and hey, AFL and NRL, I want you to pack up your whole competition and their families and the coaches and the administrators and put them into these military-grade biosecure bubbles so we can watch a bunch of guys chase a ball around on the weekend. And that is because sport is a part of the fabric of society. And the second part is that we've realized how to actually monetize that content. And if people walk away with one thing from this, investing in sport is not just about buying teams. It's about applying multiple revenue rails on top of that so that you're not stressing about, gee, I hope we have a winning season so I can sell more tickets. It is way more than that. And those things combined have democratized sport for everyone, not just a trophy asset for billionaires.
Yes, thank you. And while still on democratization, Nick, as we introduced you, WAM gives investors access to alternative assets that traditionally only were available to institutions. And with lower minimum investments now opening up to access to high net worth investors, how do lower minimums and broader access to PE funds change the dynamics of fundraising and investor engagement?
Yeah, so it's sort of an interesting dynamic because, years ago it was the play that it was just for institutional investors, and so fund managers, Aussie-based fund managers, global managers would come to this market, they would go and meet with superannuation funds, pension funds, large endowments and the like and try and raise capital, and that has now changed and there's this sort of, speaking to people yesterday and a different call around the wealth market being this holy grail, right, that people are coming to. They can see the growth in this market, but it's important to understand what that market needs and the sort of product and ensuring that the structure works for the client base. Obviously for WMA being a listed investment company, it's probably the most pure form of democratisation because it's a listed stock on the ASX, so anyone with $500 in a CommSec account can come and get access to a diversified institutional portfolio of alternative assets, that's the beauty, and that's what I love doing, and being able to talk to our shareholders and give them something that they previously couldn't access. But I think the amount of choice that's now available to the investor base is a good thing. They need to navigate that choice and make sure they're making the right decisions for their own investment portfolios.
Excellent. And Pete, how has democratisation of this of alternative assets really impacted how you do business?
I think there's probably two things. One is from the investor's perspective, a lot of the check sizes that are required in terms of minimums to get involved in the kind of investing that I do can be down in the tens of thousands of dollars, particularly in that first search capital raise, which I won't go into the detail of right now. But effectively, there are avenues to deploy relatively small checks directly into operating assets as opposed to small checks into kind of big listed vehicles. So it gives you a real direct connection with a real operating business for a relatively small check size. The other thing around democratisation, I'd say, is on the other side of the equation for the entrepreneur, so kind of young, I'll call it young, late 20s to early 40s kind of entrepreneurs with kind of mid-career that are looking at going out and acquiring a business of their own. They can now access capital, where previously that was a much more difficult path to navigate, whereas there are clear pathways now for people like that who want to raise a relatively small amount of money to go and acquire a business that they can call their own. That's much more available now than it used to be.
Great. And Sean, how are you seeing this trend reflected in your investing, and what impact is it having?
I think for us, we've never taken any. We started capital raising 10 years ago, and we've actually never taken any institutional investment, and so we've only ever been in an environment where it was high net worths, family offices, and the like. So it's always been available. We've found, but what we did find was there was an attraction for people who didn't know about private equity before sort of 10 years ago, and along the journey, even the last 10 years, the average investor in Australia is a lot more knowledgeable about it and a lot more curious about it. But it is a different style of investing in terms of there's a level of risk there that isn't otherwise in your traditional, say, share market investing. It's just different, or even holding property, which most Australians' sort of first investment is in terms of property. So I think there's a layer of sort of responsibility that comes with that, and educating people around how it is different. But even going through that, you find you get a lot of interest from people who still, might otherwise not have ever owned their own business, but they want to own a part, similar to what Peter was saying, directly own a part in a business in Australia. And so it's not hard finding people that really are really curious about it and want to own a part, and they can actually see something tangible and meaningful there.
Absolutely. And while you have the mic, we're going to transition to another theme, which is the great wealth transfer. We're often told now that we are experiencing the largest wealth transfer in history, and of course that has significant repercussions to the people that are investing and managing investments. And Sean, when it comes to this great wealth transfer, could you discuss the operational businesses that are being acquired as part of generational transitions, or perhaps any that are on your horizon as targets?
Yeah, so I guess for us, we are looking for businesses that are more mature. So they probably still sit in the small to medium business size range, but traditional private equity probably don't look at these businesses because they don't have the great growth story, but they've been there for 30 or 40 years and they are just solid. And where traditionally maybe 10, 15, 20 years ago, the path was clear for someone who had that family business, that it was going to be passed down to son or daughter. There's less of that, and so there is the need for, say, under Peter's model, where there's someone that comes in from outside that's backed into running these, or in our model whereby we will acquire it, and whether there's a succession plan internally, or whether we are recruiting a CEO to bring into the role. I just think the transfer, combined with the trend over time away from it necessarily being passed from generation to generation, it bodes well for someone to be and probably why Peter's doing it, why we're doing it, bodes well for people like us to go out there and find these businesses and give people an opportunity to run them that might otherwise never get that opportunity, or 10 or 15 years ago certainly wouldn't have.
Absolutely. We're often told that there are a record amount of businesses held by baby boomers, and they're looking to get rid of them in the coming years and decades. Pete, how is this intergenerational wealth transfer impacting your approach to investing?
Yeah, well, I mean, just to put some numbers around it, the Australian Business Growth Fund ran a study, I think it was 12 or 18 months ago, and estimated that privately held businesses in Australia with revenue between 2 and 100 million, there is somewhere around about 160 something thousand of them. And statistically speaking, a large majority of those are owned by people in excess of retirement age, and a large majority of those don't have a succession plan in place. So you can kind of slice whatever numbers you want. There are tens of thousands of businesses that need to change hands that don't have a succession plan sometime in the next 5 to 10 years. So unfortunately, regardless of how many investors we find to invest in, entrepreneurs we find to run them, there'll be some really good businesses that'll just have to shut their doors over the next 5 to 10 years because of this flood that's coming through. And that for me is a really important part of the process. Obviously there's a really good investment opportunity because a lot of these businesses, when you kind of, they're like diamonds in the rough, you cut away the kind of the rusty scale that might have accrued over the last few years as people got a little bit more tired, which is probably what you noticed a little bit. And there's really good businesses underneath. But for me, the two really exciting things beyond the financial opportunity is the opportunity to give those great Australian businesses a new lease on life, and to give these great Australian entrepreneurs an opportunity to have a crack at something that otherwise they wouldn't be able to do. So for me, I focus mostly on that stuff because that's where ultimately you then will receive the return, because matching entrepreneur and business is where you get the outcome.
I was just going to add as well, to put it in context, as Pete said, it's 160,000 businesses, right? So there's a little less than 2,000 businesses listed on the ASX today, right? Now, most people in this room will have exposure to Aussie equities through those listed businesses, but there's very little exposure to private equity. It just gives you a sense of the size of the opportunity set, the different sectors you can get exposure to that are underrepresented in traditional equity portfolios, because we know the sorts of sectors that dominate our listed markets. And so I guess that's why we're all here and interested in this space, but it is a huge opportunity.
Absolutely. And when it comes to opportunity specifically, of course, as we know, technology continues to remain at the front of everyone's radar. Many are targeting software companies for acquisition and scaling. I'm going to ask our panel now in terms of what are the operational and market challenges that investors should be aware of when investing in technology. And perhaps starting with Darren, just before we started, on the sports theme, I was telling him I knew this guy once, and he every single year bought the merchandise of his sports team, and he had it 20 years back, and I thought that was a little crazy. And he said, well, that's like a SaaS client and for a tech company. And he explained to me how this guy, who I thought was a little crazy, was the perfect acquisition target for a sports team. But if you could outline from an investment perspective with your work, why is technology, why does it remain at the forefront of investment decisions, and where are you looking now to capture that opportunity?
Yeah, well, it goes all the way from the macro perspective around where we play, which is sports and entertainment, all the way down to the day-to-day operations. So I'll give you a very practical example. We had a phone call probably about 3 months ago from a US fund manager that is heavily allocated to OpenAI, Anthropic, etc. And I was kind of like, why is this guy calling me? And he said to me, we're about as allocated to directly to artificial intelligence as we possibly can be. And what we're starting to look at now is the second derivative benefiters from that technology, if our original thesis is correct. And he explained that we feel that what AI will give people back is their time. So you'll become more efficient. You can maybe do 8 hours of work in 5 hours. So do you go to a 4-day work week earlier than you might think, or does the traditional 9 to 5 go to a 10 to 3? And effectively, what are people going to do with that time that they've now got back? And their thesis was it's going to be food, nature, and sport. Because we're not all just going to sit around contemplating our navels, writing poetry and reading philosophy. Human beings want to be entertained, and ultimately attention and content is the business that we're in. That's why I'm very specific about saying sports and entertainment. So that's in the macro sense. On the operational side of things, I think that technology is going to fundamentally change the way we engage with these assets over time, to the point where I think it's very feasible that in 5 years' time, if I'm sitting and watching a footy game with a bunch of mates drinking beers, we'll be able to watch a totally different feed to if I was sitting with my 6-year-old son watching a footy game. I think that the bespoke nature of the way that we engage with this will just get better and better and better.
Fantastic. And Nick, in terms of portfolio diversification and allocation, can you speak to us in terms of technology? Now, everyone is saying that you have to have it and have to have a lot of it. How do you approach investing in it?
Yeah, so I mean, it's interesting, right? And coming back to listed markets, right? We've seen a lot of SaaS businesses in the last couple of months being absolutely hammered by the market, right? Atlassian's down 30% in the last 4 weeks. I saw a stat somewhere that said of all SaaS businesses that are globally listed businesses, they're down 20% in the last 8 weeks, right? So I'm pretty certain you could go around and ask every private equity manager, have they marked down their software businesses they own? The answer would probably be no. And so this is all around the winners and losers from AI, right? And ensuring that any sort of accretive M&A acquisitions that are happening within these sorts of businesses are done with a lens to the exit and what that exit looks like, particularly if it's potentially an IPO and what the markets will think of that and price it, given what we've seen in recent times. Now, I think some of what we've seen in recent times will balance out, but it's, I think previously it was a no-brainer, and now I think people are sitting back thinking a bit more carefully around the tech side, particularly from an M&A perspective and getting the metrics right around it. And, you know, we do need to see some exits on the private equity side in this sector to sort of validate the valuations, I think.
Yes, and Pete, how are you approaching technology in terms of balancing this risk between the opportunity and long-term potential?
So the thing that I think, I mean, I don't want to get in a long discussion around AI and the impact on software development and all that sort of thing, but one area that I see a lot of opportunity in terms of small and medium businesses in Australia is actually hardware technology, not software technology. I remember working with the StartMate guys a few years ago, and they constantly used the phrase that hardware is hard. And I think anyone in the room that has been involved in a hardware business rather than a software business, you'll know that's true. And there are lots of really good, interesting hardware technology businesses in Australia. And one of the things about hardware technology, so for example, one of the businesses in my portfolio does instrumentation on mine sites. That instrumentation is subject to a whole control regime, like in relation to hazardous areas and various other things. So you might be able to build a really interesting, novel piece of software to solve that problem, but getting the hardware application into that operating environment is actually really, really hard. And so investing in our domestic capability around the hardware firmware layer rather than just the software layer, I think is a really, really big opportunity for us to progress.
Fantastic. And Sean, I'm interested in your approach to technology from two perspectives. Firstly, as an investor, how you're viewing investing in technology, and secondly, you work with small to medium businesses. How are you advising them when it comes to integrating these new technologies?
Yeah, so good question. In the context of what we do, as I said before, if we're looking at 30 and 40-year-old businesses, whilst it's fantastic that, you know, for all intents and purposes, if they've been operating in this manner for 30 and 40 years and making this level of money and the like, that's fantastic. We've probably got to do a fair bit to stuff it up. But the flip side of that is that the staff in those businesses are quite often, the processes and systems are built around the same way we've done this for 30 or 40 years. We've got a business that's 28 years old, and they've got some staff there that have been there for almost all of that. They still talk about doing stuff the way the founder did it, and the founder hasn't been in the business for 8 years, and they won't adhere to changing over. So that's a struggle in itself, but it's also, to Peter's point, I think there's tremendous opportunity. There's every business and every industry is different, so I don't, even if you're talking SaaS, there's any number of, and we were early investors in SaaS a long time ago, but there's any number of different ways that AI will impact different businesses and different industries in that. So we do it on a business by business basis. Fair to say, we believe that that AI will play a role in certainly improving, I think, if you apply it well, operations in businesses. It's a productivity piece for me. It's not replacing anyone. It's what people can do in a couple of hours versus what they could do in a week. Type thing. So we don't look at it through the lens of, well, how can we replace people? With technology, it's a case of how can we make people more productive or have them spend time on stuff that is more dollar productive. So we assess it very carefully right through from first discussion with people right through. And frankly, when we find businesses that have paid no attention to it they are operating really well and have good margins now, then we see that as a greater opportunity as well, because I think, whether you're in manufacturing or if you're in a high-tech space, if you've ignored it and haven't done anything about it, then there's probably opportunity.
Absolutely. We have covered a whole range of private equity investment themes, but now we are going to ask, in the next 5 years, what we see as the biggest opportunities from our panellists. Nick, perhaps yourself, next 5 years, what's exciting you most on the horizon for private equity?
Yeah, sure. So we talked about the founder-led piece. That's obviously quite key. Probably two others for us, secondaries. So when I refer to secondaries, I'm talking about the buying and selling of units in existing private equity funds partway through those fund lives. We don't have a particularly deep secondaries market in Australia. That is going to change. It is now being used as a proper lever for liquidity, as opposed to buying units in something that, frankly, the underlying assets are pretty poor quality. Because we haven't had as many exits in this environment, we're seeing investors actually sort of look at that as a lever for liquidity. And we've also had a huge amount of consolidation amongst superannuation funds that are now holding small positions in things that are frankly not part of their sort of strategic vision. So I think we're going to see more in secondaries, which creates a really interesting opportunity for nimble investors. And probably the only other element is in credit. We've obviously seen a huge amount of capital get deployed into private credit. I think some of that will unwind. I think there's going to be some disasters, but that does create an opportunity, right, for skilled private equity investors that are very good at turnaround, and also distressed credit groups. So we're keeping a close eye on that space, so we're ready to go quickly when the opportunity arises.
Great. And Pete, next 5 years, what excites you the most?
So I've touched on a couple of the themes already, but the main thing for me is the opportunity to back these entrepreneurs into these businesses and keep those businesses alive. I think there's a real issue from a broader perspective in Australia around the maintenance of our economy, frankly, that is driven by a lot of these small businesses. And so the opportunity to be one part of the solve for that, I think, is really exciting. I think the other thing is that investing in acquisition entrepreneurs, or ETA, which is where I play, is really developed in North American and European markets. And so we can look to those markets to see what our market could look like in the next kind of 5 to 10 years. And they've got very deep and broad kind of opportunities to participate in those markets, and I think we've got the opportunity to build that here in a more accelerated way because we can follow their lead.
Brilliant. Sean, next 5 years?
Similar. And we've already talked about it. I'm really, really sort of excited about this transition from one generation to the next and being able to facilitate that. And the second part of that excites me is we're actually seeing a lot of, and we've talked about it up here, a lot of CEOs going into running businesses that they actually didn't found the business, so they haven't been through that founder journey, and they're replacing a founder in a business. And the decision making is so far different. The level of resilience that the founder had and their ability to solve problems has just gone from the business, and people stepping into first-time CEO roles, no matter how they've studied, what they've read, where they've worked for someone else, it's just different. And so I think the challenge and the excitement is in developing those people and doing it in a way whereby we're learning how to do it quicker and faster and getting people up to speed quicker, because you've got new CEOs going into businesses that they've just lost that founder gene in it, and you don't know till it's gone, and they're the things you can't find it during due diligence, and they're intangible. So bringing that next generation through of leaders is exciting to me.
Great. And Darren, you've told us that Australian sport is where American sport was 10 years ago. What are we going to be seeing in the next 5 years?
I don't think I need 5 years. I think I need 5 months. Big Bash, the Big Bash is going through a privatisation process. The states have agreed. That's happening in June, July. I think that you'll see teams like Sixers, Scorchers, Renegades, Stars go for prices that are going to make people's eyes water, particularly if IPL owners come in and try and get a piece of our market and local syndicates form and try and keep the Big Bash from becoming an IPL B League. I 100% agree with Pete. If you look at what has happened with the ETA space, and I think what Pete and Sean are doing in Australian society is God's work, helping these business owners who've worked for 30 or 40 years, built amazing businesses, helping them transition. I think it's a valuable service they're actually providing to society. I would look at what has happened at sports entertainment in the US and just apply that model here. And you have catalysts coming up, like I said, like Big Bash, that is going to wake the market up to just how underpriced and misunderstood this asset class actually is, and the potential that we have in our region over the next 10 years is incredible.
Well, it certainly is an exceptionally exciting space. I would like to thank all of our expert panelists here today for your expert insights, and please join me in thanking everyone. I hope you've gotten a lot of value. Thank you.
Thanks again to our panelists for that insightful session. Following the panel, we have a presentation from our sponsor, Rocking Horse, specialists in R&D financing. Please join me in welcoming their head of sales and marketing, Cameron Story.
Good morning, everyone. My name's Cameron Story, and I am from Rocking Horse. We provide non-dilutive finance to Australian companies investing in R&D and claiming the R&D tax incentive. Just to be clear from the outset, this isn't an investment pitch. We're not raising capital. We're here because a lot of founders realise there's a very practical funding tool available to them that solves a problem almost every innovative company runs into at some stage. If you're a founder in the room, and hopefully there's a few, this will feel familiar. You're hiring engineers, paying contractors, iterating and building. All of that costs money now, but a lot of the support designed to help you, especially that from the government, arrives much later. That gap between when you spend the money and when the cash hits your account is generally where momentum gets lost. Hiring slows, projects pause, and focus shifts from building to plain survival. And importantly, this problem shows up earlier than most founders expect. Most innovative companies here are already pretty familiar with the R&D tax incentive. We've been presenting it here for a fair few years. You spend the money now, you do the work, you lodge your return, and eventually you receive a rebate. And often it's a very meaningful one. But founders often treat this as bonus cash. It's not bonus cash, it's earned money that just arrives later. And that delay is often exactly when cash flow matters most. And this isn't only a scale-up problem. Some of our earliest stage clients are pre-revenue, building MVPs, running pilots, or making first hires. They're not scaling aggressively at all yet, they're just trying not to stop. Many use R&D finance simply because they're not ready to raise yet, and they don't want cash timing forcing that decision. Sometimes all they want is another 6 months of focus. So what exactly is R&D finance? Look, it's not venture debt, it's not equity, it's a loan secured against your future R&D tax incentive rebate. If you're undertaking eligible R&D, you may be entitled to a rebate of up to 43.5% of that spend. We simply bring that forward so you can use it when you need it most, not months later. And you're not betting on future performance, you're unlocking money that you guys have already earned. And where this becomes really powerful for founders is actually how they use it. Early stage founders use it to extend runway, hire key technical staff, or avoid raising too early. Founders preparing to raise use it to bridge to that next round, hit one more milestone, and stay focused on execution rather than fundraising. Different stages, but the same core problem. Cash timing shouldn't dictate your strategy. The process itself is deliberately simple. First, confirm the eligibility for the tax incentive itself. Then we review a small amount of documentation around your R&D spend and your finances. And once approved, funding's typically available inside 2 weeks. Our funding ranges from anywhere from $50,000 up to $10 million, depending on your R&D activity. Obviously, we don't get too many $10 million loans, but we have the capacity to finance that. And this is where founders generally really see the benefit. R&D finance gives them control, optionality, and breathing room. It also it allows you to decide when to raise equity rather than being forced into it because of cash timing. Raising capital isn't a problem. We're all here to do it, but raising earlier than you need to can be expensive. This tool helps you reach stronger milestones before you have to go to market. And you can think of this as part of your normal funding mix. Bootstrapping, grants, R&D finance, and then equity when it makes sense. It doesn't replace equity at all. It just gives you more control over when you can use it. For investors in the room, briefly, this often reduces pressure on your portfolio companies, delays premature raises, and keeps founders focused on building. It's better outcomes all round. So R&D finance, look, it isn't right for everybody, but if you're investing heavily in R&D, feeling that cash flow timing pressure or wanting flexibility ahead of your next raise, it's definitely worth understanding. If nothing else, you walk away with another option in your toolkit. So thanks very much for your time. That's it. It's a fairly simple process, as I said. Enjoy the rest of your conference, and please come and have a chat to us outside if anybody would like to know anything more.
Thanks, Cameron. Next, please welcome Straightcurve, a global leader in steel edging solutions. Their patented modular system and automated scalable manufacturing have already achieved proven traction across multiple countries, all while maintaining strong margins. To share their vision behind their growth, please welcome their CEO and visionary, Yuri Town.
Thank you. A couple of years ago, I was part of a business group where I was asked to write a eulogy for my own funeral. You can imagine my shock and surprise. After scribbling words on a piece of paper for about half an hour, I read it out loud to other people in the room and realized a very important lesson. I wrote about how I wanted to be remembered, what was leaving behind, and not what I had created or built. And realized maybe I've been focusing on the wrong thing. Because in the end, the only thing we can do is leave things behind. There's nothing we can take with us. My name is Yuri Town. I'm Dutch. I started a company 11 years ago in premium steel garden edging. We're on track this year to do $20 million in turnover, with $3 million in net profit. We're looking to raise capital in the second half of this financial year for our first expansion, first new expansion in Europe. Let's go through a few details. We're already selling in 7 countries worldwide, including my home country, the Netherlands. And we're looking to expand in any region where we have houses with gardens, which is quite a few. It's not too hard for us to work out what our market share might be in any of these regions based on some basic metrics. The countries on the list here together represent a $500 million turnover once the markets mature. We just opened a brand new purpose-built factory in China. It's fully robotic, can handle large volumes, and we can replicate this particular factory anywhere we want as well. We have a strong competitive advantage. It's difficult to do what we do. Now, most people would say that. We have a vertically integrated supply chain. That's very hard to do. We have a large network of distributors around the world. That's difficult to build. We have IP around the world, which is difficult to copy. At the moment, there's only one other company in the world doing what we do at this kind of level. The opportunity is clear. The 5-year projected turnover will exceed $100 million turnover, and the net profit will increase to 25% as economies of scale and efficiencies kick in. We're looking to raise 1.6 million in the first round, and in return offer an equity of 5%. But is this the part that really matters, is the question. What you want to ask yourself is, why am I here? It's a large company doing a decent net profit. I can retire. Yet I'm working 50 hours a week with great passion and dedication, and I'm talking to you about raising capital. Why? Because I believe I can make a difference with my whole being. 8 years ago, I was talking to my first business mentor, and he said, Yuri, if you are serious about making a change, making a difference, you're going to have to make as much money as you can. Because with money, you can hire a team, expand your company, and grow your influence. And I took that on board. So the question is not if I can get this company to $100 million turnover in the next 5 years, or even $500 million in the next 10 years. The real question is, are you going to be there with me? It's going to happen. I'm a strong visionary. I have massive plans for this world. I don't really have time to go into the details of what I'm doing, but I do want to talk about how we scale and grow. Because this is the part that really matters. This is the team at Straightcurve Australia. We started this company 4.5 years ago to take over distribution inside Australia. What do you see when you look at these faces? We focus on the people. It's culture first. So the challenge I think we face nowadays, especially with AI coming up, is how to maintain a human connection. And so our focus in the company is to help people stay in their hearts and connect with the people around them, which builds the most powerful connections. None of these people had experience in this particular field, yet they've grown the company 22% this financial year in our 11th year of trading in Australia. That's incredible. People want to deal with these people because they're likable people. They build connection with their dealers, build connection with landscapers, and they keep them on board. The whole company has been running under management since day one. I'm not involved in any of the day-to-day. If you meet these people, you'll find they're lovely people to hang out with. And that's the part we're scaling. So we grow the company by growing the people. Rather than seeing them as an individual we put into a box and whip them into shape and optimize them for efficiency, we see them as human beings with wants and needs, hopes and fears, and we encourage people to be themselves. Because the more vulnerable they can be, the better the connection is that they can make. And that's the essence. So I'm here to look for people that are aligned with my vision. They want to spread connection around the world, because that's what we're doing. We're building little pockets all around the world with connected people, helping them, and this is systemized, by the way. Every week, we have an exercise where people check in with each other and they practice being vulnerable, which gets them closer together. And this is the model that we roll out everywhere. So I'm curious to hear if anyone here might be interested in joining that mission. If so, I look forward to meeting you and talking to you and hear about what keeps you up at night, what gets you out of bed in the morning, what lights you up, what fills your cup. And I'd love to hear what a meaningful difference means to you. And when it is your time to leave this planet, what you're leaving behind. That's a conversation worth having. Thank you.
Thanks, Yuri. Moving into the world of business efficiency, we have SaaSplications. They have developed a flexible cloud-based ERP that unifies financials, operations, and industry-specific workflows into one highly configurable system, helping companies streamline complex processes with ease. Please welcome their director, Paul Sawkins.
Thank you. The last time I was at this building, I was abseiling down the outside, and it was pretty exciting. It was a fundraising event. So I'm hoping that today is just as exciting for us. We're SaaSplications. Myself and my co-founder are here next door. We're a very simple business. We charge monthly subscriptions and to do work to build out the system. We have pretty cool tech, and we own 100% of our intellectual property. I think to understand the business, you have to understand how we got here. So in 2010, it was decided to go after a tools business. Our founder started with a tools business to build out capability over .NET. And it's a very large marketplace, and there's a $100 billion marketplace out there. But to get that marketplace, you have to get a large organisation to publicise a product. And so we went out, got an investor. The investor funded $1 million into developing out the technology, which was building software. We went to a Cisco incubator over in the US, and while we were over there, we went and spoke to a number of the venture capital firms in the area who all said, if you do well in that Cisco incubator period, we'll give you some money. So we raised $5 million, and at the same time, we had a document from the Australian government saying they'd match it. So we had $10 million lined up. However, we had an investor who saw the term sheet, had 24 hours to decide on it, and rejected it. So that $10 million dried up. All those people said, they're all associated with Cisco and said, we're not continuing with this. The other alternative was to take it to Microsoft, a large organisation that dealt with .NET that would take it out to their developers. They had a close look at it, and after a period, decided against it. So the investor that we had, who's an investor in Australia, said he was out, he was only interested in tools. But while we'd been doing that, and so we set up a completely new business. While we'd been doing that Cisco stuff and the Microsoft stuff, we decided to prove that our stuff was good by solving a difficult problem. So we decided to solve an ERP problem, actually build an ERP system. We had two organisations that we seeded with, that we started with. One organisation was a friend. He was distributing a kombucha product out of New Zealand. He had a garage and a truck. So he started with nothing, we started with nothing. Within 6 years, he built that business to $40 million and an exit. He was operating in all the states in Australia. He had warehousing. We were doing all the trucks, all the picking, packing, picking in reverse order delivery. It was all expiry dated product. We were forecasting for that, sales management. At the same time, we did another company, which is an Australia-wide distribution multi-level marketing company. And they sell kitchen appliances around Australia. They couldn't find software to fit that kind of business, so we worked with them. We were doing everything to do with that, all the stock, all the repairs, the multi-level marketing, managing all of that, all of the commissioning and things like that. So we had those two businesses, and then we started out into some others. So we got tours and coaches. So there's a business at the moment which international tourists book. They assemble them all into the coach. We schedule all the drivers. People turn up, and the drivers check the vehicles. They get told where to go, where to pick people up. They pass around iPad around the bus in order to order the food. So when they arrive at the restaurant, the meal's are ready. And we work out who has to be paid, all the money has to be collected, and we do all the accounting and everything for that business, so everything for it. We also took up a house inspection franchise. The house inspection franchise is in each state in Australia. They have inspectors that go out on site. They have a disconnected client. They go and answer all the questions, take photos, mark it all up. We do all the pricing up front. We do all the invoicing down the back. They do project inspections, multi-inspections on sites. We work out who has to be paid, how much they're going to be paid, collect all the money, create the documents which are defensible in court. We also have a retail phone organisation. They have 15 stores around Australia. They're all separate ABNs. They all communicate with each other. We're the point of sale, all the marketing proposal stuff. We pull in orders from Shopify, which go out within hours. And we do all of the management of all the stock, the forecasting, the replenishment, all of the point of sale style promotions and things that need to happen. Excuse me. Also a high volume B2C organisation. They bring in 1,000 orders every day that goes around to Australians, and they bring it in from 50 different marketplaces, eBay, Amazon, all those kind of things. They bring it all in. They get over 100,000 stock locations. We do all of the picking management. We do all the forecasting. They buy things in kits, so they buy a garden set instead of buying all the individual pieces. We could bring it in, put it in stock, sell it. So there's a lot of complexity in all of this. We built out a solution for health clinics, which involved the practitioners, something for them to manage their time, and also for the clinics to work out how to charge people for a room or for hours or based on commission and things like that. And furniture retail and manufacturing, where you go through and do a configurable product and you choose all these different things in order to choose a sofa, and then you have to go and manufacture it. And it's quite a complex manufacturing process. You're not building the same thing over and over again. Each one's unique. You have to go out and get all the pieces you need before you put it together. And our latest one is a construction industry compliance solution. There's an organisation that Safe Work came visited site. They got a $300,000 fine, and they said when they were investigated, they didn't have good compliance systems, and they're on the board of the association, so that knew everybody had the same problem. So we're building a platform, which is a self-sign-up platform for all the people in that industry, and it's easily pushed out to other relatively similar industries. We have a single code base, and we have 2 developers. So we think we've proven that our capability for building software, building very flexible software with very few resources, is done. We did some load testing about 10 years ago. We created a simple banking app, 10,000 concurrent users, 160,000 transactions a minute, running in Azure across different geographical locations. It was linear scalability as servers were added. So we needed to test that the tech wasn't something that wasn't robust. 10 years later, we updated to gRPC. People who are technical would know that's actually very hard to do for businesses that are established. We're on .NET 10, and we're in a banking data center, so we're a very secure environment. Our financials, 300,000 per year average. We've been bootstrapping effectively, earning from our customers over the last 12 years. We've been focused on building out our proof. So we haven't been trying to capture a market. We haven't been trying to grow. We're trying to prove the fact that we can do a lot with few people. The current project we've got starting in a couple of months is a second tours company. It's about $80,000, $5,000 a month. We've got a compliance project which we're targeting in 3 years, probably about $500,000 a year. And we have additional projects in the pipeline. So we want some investment. We want some investment to grow, but I guess we're really after someone who's really got some ambitions. We think we've proven we've got great technology. We've got a great solution footprint. We've got a lot of information there. We've got a lot of capability. We just want to get somebody to get interested in that and help us take it to the next level. So we would take that to get some salespeople, some more devs, a BA, but really that is to create more proof. A lot of organisations are only interested in funding companies which have growing revenue. We haven't been focused on that. If we do get those people, we can focus on that, then we can attract that kind of investment. So we do dream of bigger things. Potentially acquisition by an organisation, for example, like SAP, Atlassian, X, Google, someone like that. The reason I say SAP is I worked there for a number of years. They brought out a product called Business by Design. They had a building full of people building it over a number of years, and it failed. This stuff is hard, but we think we've done it. The technology we can talk to, we've got our technologist next door. He'll talk about the scalability and the security associated with that, and how we do it very simply across many different types of businesses. So I think I've run out of time. Please come and see us next door if you're interested in talking to us. Thank you.
Thanks, Paul. We are pleased to welcome our sponsor, InvestHK, to discuss the massive opportunities for expansion and investment in the Hong Kong market. Please welcome their Head of Business and Talent Attraction, Max Lau.
Hello, good morning, everyone. So the key message that I would like to highlight during this presentation is that no matter you're raising for funding, or you're trying to scale up your growth in the overseas market, or if you're sourcing for investment deals, then Hong Kong is the destination for you to consider. And I'll walk through you in the following presentation slides. So in a nutshell, Invest Hong Kong is actually a government department of Hong Kong, and then we have actually presence in 35 different cities around the world. And then the key purpose that we are doing is that we connect you with the ecosystem in the Hong Kong market, as well as the relevant stakeholders, be it like investors or the different incubation hubs in Hong Kong. So for Invest Hong Kong, we cover 9 different sector teams, and then the 2 sector teams that I would like to highlight here includes the innovation and technology, which covers AI and data sciences, as well as health and life sciences, as well as the family office and financial services team. It is because we do see a very strong synergy between the traditional industry like financial services, family offices, as well as the emerging industries like innovation and technology. It is because like for the family offices in Hong Kong, because they have a relatively flexible investment mandate, so they're increasingly looking for emerging technologies as an investment opportunities. While for the innovation and technology companies, they do find Hong Kong as a launch pad for them to, first of all, to get connected with the different family offices in Hong Kong, as well as potential investors, and secondly, as a launch pad for expansion into the mainland China area. So as an overview about the presence of the overseas companies in Hong Kong, we do have like more than 11,000 overseas companies based in Hong Kong, and more than 1,500 of them sees Hong Kong as their regional headquarters. So you will not be alone when you're in the Hong Kong market. There will be plenty of companies right next to you. And then in terms of the locations of those like overseas companies, they're actually from mainland China, using Hong Kong as a launchpad for overseas expansion into the other countries, as well as those countries, for example, say United States, UK, and Japan, as well as Singapore. They see Hong Kong as a launchpad for them to further penetrate the mainland China market. It is because during the conversation that I have with the companies, like they do express that like China is a huge market to conquer, but it can be slightly daunting as well as complicated when a company first step into that market. But while in Hong Kong, you can use that platform to get connected with different investors from mainland China, as well as different, say, associations and government organizations which are operating in Hong Kong, to provide you with a risk mitigated path to gradually penetrate into the mainland China market. And the key messages that I would like to highlight in this slide is the low cost of operation in Hong Kong. First of all, in terms of tax rate for the businesses as well as the scaled ups, we only tax on the profit tax. And then we do have a 2-tier profit tax system. For the first $250,000 US of operating profit, it is only taxed at 8.25%. And then for the profit, which is above 250,000 US dollars, it will be tested at a flat rate of 16.5, which is relatively competitive compared with the tax rate here in Australia. And in terms of the labor cost, the minimum wage rate in Hong Kong is close to like 8 or 9 Australian dollars per hour, which is and then we do have like very competitive as well as like very responsive labor in the Hong Kong market, which further accelerate the growth with the company. And then in terms of the abundance of the financial institutions as well as different sort of like funding opportunities in Hong Kong, we do have a concentration of VCs, PEs, as well as family offices. As per the latest survey of Invest Hong Kong, we have like more than 3,300 single family offices operating in Hong Kong, which is a growth of 25% compared with 2 years ago. And then that's also a destination for different companies to seek listing in the stock exchange. And then in terms of like the IPO market in Hong Kong, it has definitely been thriving and growing in the past couple of years. And then we do see that a large number of the companies actually from the innovation and technology area, as well as the health and life sciences area. And right now, as per the statistics of the Stock Exchange of Hong Kong, we have more than 300 listing applications in the pipeline waiting for the approval. And the main reason for the thrive as well as for the strong growth of the IPO market is that like we do have very favorable listing rules for the emerging businesses. That is to do with the 18A as well as the 18C of the listing rules in Hong Kong, which provides the pre-revenue companies in both emerging technologies, for example, say AI and data sciences and blockchain, as well as life sciences and biotech companies to seek a path of listing in the Hong Kong market. This actually provides a channel for different businesses to accelerate their listing plans. And then about the connectivity as well as the proximity with the other countries of Hong Kong. So you can see from the map that within 5 hours, we are actually within very close proximity to the ASEAN market. For example, say the Thailand, Vietnam, as well as Malaysia and Singapore, which are rapidly growing markets in the Asia region, as well as relatively mature markets, for example, say Japan, Korea, which are known for their development in the innovation and technology as well. And we do have like free trade agreement with a lot of different countries in a row. So by setting an entity in Hong Kong, you're not just connected with the Asia country, but then with our free trade agreement, you're actually connected with the global audience as well as the global potential customers to enjoy the low tariff as well as low cost of operation. And then about our connectivity with the mainland China market, like usually for the overseas companies, they'll start with the Greater Bay Area when they're penetrating the mainland China market. That is actually the area which has a very high concentration of growth as well as population and wealth. You can see that like it does have a GDP of 2 trillion US dollars as well as a population of 87 million. And that's also the focus area of the mainland Chinese government in terms of like developing about the economy of mainland China. So a lot of resources has been put into the development of the Greater Bay Area, be on the support and the establishment of the innovation hubs in that area, as well as support for different enterprises. For example, say Tencent as well as like JD Technologies. They do have their like headquarters as well as like regional operation in the Greater Bay Area, which also provides a very good opportunity for different overseas startups to get connected with the potential Chinese business partners. And from this slide, you can actually see that currently we do have like more than 5,000 startups in the Hong Kong market, which is a growth of 10% compared with last year. And then for the startups, they're actually from a range of different sectors. For example, say biotech, fintech, as well as like information and technology. That shows the benefits of the low cost operation as well as the connectivity of the Hong Kong market. And the government has also been devoting a lot of resources to support the growth of the startups. For example, you can see that like for the HKSTP as well as the Spaceport, they are the innovation hub of Hong Kong providing support to the startups. And then for Invest Hong Kong as well as Stock Exchange, we're also keen to get connected with the startups to provide further information. So I'm aware that time is almost up. So just to wrap up with these slides on the overview of the funding programs in Hong Kong. So you can see that from the startup stage all the way to IPO stage, there will be funding opportunities, there are support available. And you can also scan these QR codes so that you can have access to my LinkedIn account, and definitely keen to continue the conversation with each and every one of you. Thank you.
Thanks, Max. As global demand for sustainable and functional superfoods skyrockets, our next company is commercializing a powerful alternative to traditional dairy. Good Earth Dairy is Australia's leading camel milk producer, leveraging world-class IP to disrupt the $15 billion infant formula and dairy markets. Please welcome the CEO of Good Earth Dairy, Marcel Steingieser.
Thank you for the introduction. Good afternoon, everyone. I'll keep this presentation at a very high level to see if I can gauge your interest. So I'm going to tell you about a project that will unlock a $15 billion segment in the global infant formula market, but with a significant potential to unlock a lot more. Now, currently, there's an unmet market need. We have a $15 billion hydrolyzed infant formula market that, according to all the market surveys and research that have been done, causes 50% of parents to feel like they are force-feeding their infants their feed. Now, the reason for that is that the most prevalent allergen in infant formula comes from the cow milk protein. It actually lives within the whey, and it's called beta-lactoglobulin. Now, this allergen, to try and make it so it can be massaged and infants can absorb the nutrition, they use a process called hydrolysis. This process denatures the proteins, so it actually makes it not to the optimum position that an infant would like, but it also sours the milk, hence the food rejection from this infant formula. Now, also, a large cause of digestive complaints by infants, not necessarily to the level of the allergen, and which is why I said there's such a huge opportunity above and beyond this $15 billion segment. Sorry for using a water bottle to demonstrate a milk bottle, but if you imagine a milk bottle, for those who've ever fed a little one, full of liquid milk, and you put that into the infant, everybody sees the liquid milk, everyone thinks, great, I've done my job as a parent, I've given my infant the feed that they require for their day, or for that period, depending on how young, of course, you have to feed more frequently. Now, this liquid actually will harden in the infant's gut, an immature digestive system that is used to human breast milk that remains as a soft curd in the infant's gut. It does not harden. So other than being the most hyperallergenic protein, peer-reviewed by CSIRO with a stamp, just, this isn't something that needs further validation. This is water's H2O equivalent of validation. Other than that opportunity around the lack of allergen, it's the fact that it is the most digestible animal protein and therefore can do a lot more than the 15 billion segment. But as you can appreciate, the $15 billion segment has no solution, and as a result, huge opportunity to take that forward. Now, the solution, as highlighted in the introduction, camel milk. I'll go into a little bit about why Good Earth Dairy in a minute, but camel milk is the only animal milk, so cow, sheep, and goat milk, and donkey milk, and any other milk out there, has been identified to have beta-lactoglobulin, the allergen not present in human breast and not in camel milk. But it is also the only animal milk we know of that will not hard coagulate in the infant's gut. So again, creating a soft curd that's easier to digest. And also very importantly, it's a neutral taste. Manufacturing can be done in traditional process with a lot of different technologies, components, which I won't go into here. But it doesn't need to be hydrolyzed. So you've got optimum nutrition for that $15 billion segment, creating a product that any parent will jump at to acquire to make sure their infant gets that nutrition. Now, Good Earth Dairy, a little bit about us. Again, we've spent around $9 million on some serious design of experiments and R&D to understand and improve, and BHP framework developed the technology to commoditize this opportunity. We have got a 2,000-acre block about 2 hours north of Perth. We've done a pilot facility vertically integrated to fresh feed, not to powder. The powder we've been using CSIRO to produce some, and some other companies overseas. And we have developed a vertically integrated facility that will ultimately bring the costs down to alignment with bovine cow milk. So this is thanks to our industrialized herd with the improved genetics, higher yield, the technology, the niche design of the dairy that we've built, and of course coupled with some scale. It doesn't have a huge scale requirement. We can be a world leading in price, but also very importantly, and this is something that I have to stress, is the quality of the milk. Without quality milk, you can't make stage 1 infant formula. There is no stage 1 camel milk infant formula globally right now. The Camelicious from Dubai has made stage 3, but have been unable to produce stage 1 or stage 2. So we're hoping to be the first. And the other component there is the de-risking study that demonstrates that our modular dairy can be quite easily built in Western Australia, which is where we're based. And thanks again to the government for backing this feasibility study. We've de-risked and ensured there's no regulatory or other compliance issues for us to build this facility. Now, there are three. The business model for our facility is we intend to have our own branded infant formula product, but not just infant formula. You can imagine the most hyperallergenic protein can be used in a large powder segment, but it's well and truly the lowest hanging fruit where we can make the maximum margin. But once the awareness grows, a large portion of the infant formula industry is built on companies that don't own any vertical integration at all. They buy all the ingredients. They use their market and distribution channels to move infant formula. We intend to be that ingredient provider to that industry based on our capability to scale incredibly quickly. So just a side note about our capability, there's approximately 1 million wild camels in Australia, plus or minus 250,000 you can put. Due to satellite technology, we don't have the granularity capability to define exact numbers. We can harness as 120 a fortnight or more, depending on the requirements for growth. 7 months have a facility ready and commissioned, and thanks to that very healthy wild herd population, we've developed the entire capability with minimal human labor to be able to scale incredibly quickly as market demand grows. And lastly is the fresh milk, fresh meat opportunity with different products. We've made cheese, kefir that are selling out in Western Australia in the supermarkets. And there's a significant market there already in the Middle East where the sentiment for camel milk is incredibly powerful. But also I just have to make a note that the Chinese market is actually one of the most aware about camel milk benefits as well. There is a $1.7 billion market there already with camel milk products in certain regions due to the double-humped camel, not the one we have in Australia, from the Middle East. And again, that's again highlights a low-hanging fruit market entry. Now, we're looking for $500,000. This will allow us to complete the final design engineering drawings of the manufacturing facility. And I'll talk about the next steps in another slide, but this will also trigger the ability to engage the $4.4 million government grant that was awarded to us also by the state of Western Australia after Deloitte's due diligence on our project to allow us to move forward with this manufacturing facility. Now, I touched a little bit about the opportunity with the Chinese market. I think most of the people in the room know about the reputation Australian produce has in China, and thanks largely to the Amazon equivalents in China, and I apologize to the people in the room that I cannot pronounce this correctly, but the B2C of Alibaba, Xiaobao, again, apologies for the pronunciation, and JD.com has enabled a significant amount of the red tape to be removed to penetrate the Chinese market relatively quickly with market awareness, Australian trademark, and being differentiated as the premium and best milk chemistry and formulation for the population of the world. This isn't a China or an Australia, this is a global opportunity. Our goal is to take 1% of the market. As I mentioned, $15 billion is a extremely low-hanging fruit because there is no current solution. We want to take a large share of that $15 billion, but also the premium market, because it doesn't matter if your infant is allergic or not. Every mum and dad wants the best for their young one, and the price elasticity is incredibly low because we can charge $50, $60 more a tin. Not many people who can afford that in that top 1% are going to, it's not going to make an impact on their pocket, a tin a week. It's not a huge impact on the financial situation of families, but an easy sell to take that extra amount. Sorry, I just realized my time is up. I'll move quickly through the rest. So very conservatively, $67 million turnover for this next very small step in this facility. And I say extremely conservative. And I'm happy to put this on paper and demonstrate with financial models that we can quite comfortably go above $100 million turnover. But this is the very baseline with a 50% EBITDA. Now, at a 3x on the 67 million, it's above a $200 million valuation for our intended IPO, which I'll touch about in a minute as well. And the current market valuation of our 3x, our current enterprise value, is less than 10% of that. So incredibly humbly valued right now for an investment. And the next stage is to actually do the project finance backed by asset. The majority of that capital is going to the manufacturing facility of $18 million, along with some offtake contracts that will be backed to exclusivity agreements that we're looking to formalize. And the intention is to IPO in 12 to 18 months. Of course, we'll do some documentation preparation and the listing documents, a lot of which we've done already, to have them ready upon commissioning of the facility. Look, I'll leave you to read the summary because I'm out of time, but ultimately this is a commodity opportunity, and we intend to be the number one supplier, the BHP of camel milk powder globally and infant formula. And any questions, I'll be in the room next door. Thank you all for your attention.
Thanks, Marcel. We now move on to the aerospace sector. We have the Western Australian Spaceport. They provide licensed launch infrastructure specifically designed to enable secure, high-cadence orbital testing for both defense and commercial innovation. Please join me in welcoming their founder and CEO, April Walker.
Thank you and good afternoon. When people talk about space infrastructure, they usually start with launch. But launch is not where most programs succeed or fail. They succeed or fail much earlier, during development, where teams need to test, iterate, and learn. And that part of the system is where global infrastructure is thinnest. WA Spaceport exists to address that specific gap. It is development infrastructure, not a launch business. Across space, hypersonics, and advanced defense technologies, the limiting factor today isn't about ambition, talent, or even capital. It's access to repeatable, real-world flight testing. Globally, ranges are congested, heavily regulated, and optimized for missions, not for development. As a result, companies that are technically ready to test face long queues, inflexible schedules, and high costs for what should be routine validation. As a result, companies that are technically ready to test are stalled. This creates a structural bottleneck that slows innovation and increases failure risk long before orbit is ever reached. Development requires repetition. Launch infrastructure is built around events. Those two models sound similar, but they behave very differently in practice. If you need to fly once, you can wait. If you need to fly repeatedly, waiting destroys momentum. Yet globally, there is very little commercial infrastructure designed specifically for high-cadence, campaign-based flight testing. There is a very useful parallel I would like to use here. In mining, no one confuses an assay lab with a mine, but no serious mining operation proceeds without one. The assay lab doesn't extract value, it de-risks extraction. It allows teams to test, validate, and make decisions before committing significant capital. What assay labs are to mining and wind tunnels are to aviation, development test infrastructure is to in-space technology. It is not where the product is sold. It's where success or failure is determined. And physically, that means a licensed test range, not one-off launches. WA Spaceport is not a launch company. We are not betting on who wins or who loses the race. We are building a private, orbital-capable development test range designed to support repeatable flight testing of propulsion systems, spacecraft, sensors, hypersonics, and early-stage launch technologies. The facility is engineered around learning cycles. Test, analyze, refine, and test again, again, and again. We do not run missions, we run development campaigns. That distinction defines everything: the infrastructure, the operating model, and the economics. WA Spaceport serves a structurally underserved market. Our users include in-space propulsion developers, hypersonics programs, spacecraft subsystem teams, defence primes and subcontractors, and allied research organisations. What they share is the same requirement: reliable, repeatable access to flight testing. These are not one-off users. They embed testing into their development cycles, and that creates long-term relationships. The business model reflects that behaviour. We monetize cadence, not events. Revenue is generated through campaign-based access, long-term user agreements, and recurring utilisation, rather than one-off launch fees. This creates predictable demand, high switching costs, and durable revenue over time. Infrastructure of this kind is difficult to replicate. It requires licensing, regulatory approval, land tenure, community trust, and significant capital. Once a program integrates testing into its development pathway, it doesn't move lightly. This is what gives this asset long-term defensibility. This project is no longer conceptual. After completing key regulatory, land access, and stakeholder milestones, we commenced on-site activities in September last year. We are now transitioning from planning to delivery. We are actively deploying capital to complete our regulatory phase and secure our initial operational test campaigns. This is not a bet on which company wins the space race. It's a bet that the race continues and that development infrastructure becomes more valuable as iteration speeds up. WA Spaceport is being built to be quietly indispensable, and that's the opportunity. Thank you very much.
Thanks, April. To lead us into lunch, we are privileged to welcome Ken Shaw, founder of Main Beach Advisors. After 15 years leading venture-backed software firms in California to market dominance, Ken now focuses on scaling B2B software and the transformative power of AI. Please join me in welcoming Ken Shaw.
Howdy, folks. First session for lunch, but I'm going to try and wake you up a little bit. Surviving and thriving in the agentic AI era. The subtitle here sums up what I want to say. So AI and agents are changing right now the nature of work and value creation. That applies to workers, owners, and investors. Those that lead on this right now are going to thrive, and they're going to be industry leaders in terms of it as individuals in the future, and their companies will be industry leaders. Those that don't are in big trouble. Companies and careers are going to be destroyed in the next 5 years. So who am I to have an opinion? I'm Ken, the AI guy. So if those who were here yesterday and saw what Steve Torso's building with CapHQ and the new AI system, that's my team who's building that. But I've built 2 large software companies in my life. I've bought and sold software companies, many of them. I was a CEO and founder and entrepreneur, but then went to the dark side and went into private equity and bought and sold more software companies. So I know software from the ground up. I'm a coder. I'm still on the tools. I love to code. But I then sort of, went through the whole professional arc that a coder can. I'm in the trenches. I'm building, systems. I'm more doing advisory work these days for clients ranging from Fortune 500 companies to Middle Eastern governments. So what I'm saying today is a glimpse into what's coming to Australia in a little while. Australia's always behind the rest of the world, but it's coming. And this second to last point is kind of key. Over the last few years, I've destroyed a lot of jobs. And that wasn't deliberate, but it is the natural outworking of what AI agents can do. So last week, Steve and I did a 4-hour workshop for 12 CEOs, and they liked it a lot. So I'm going to try and pump through that in 15 minutes. So I'm going to go fast, but the slides are available with the QR code, and we're also doing a workshop next week, just a 1-hour masterclass on AI agents, which is free, and you can come to that if you're interested. So Sundar Pichai, CEO of Google, he thinks that AI is as important as fire and electricity. And whether that is true or not, it's that belief that explains the $1 trillion that's already been spent. Big tech is spending money on AI like nation states spend money. And part of the equation is not just what AI can do, but it's the speed with which it's coming, right? So Netflix or streaming video took 10 years to get to 100 million users. Streaming music, 5 years. AI took 6 days, okay? We've never seen anything like it in our lives. But speed is only one part of the equation. The other thing to know about AI is it represents a fundamentally different way of doing things with technology. And it's a step function up. And that step function is continuing to ladder up every 90 days. It's insane. So that with AI, it's both the speed of the change and the quantum of the change. I argue it's as important and as transformative as each of these computing paradigms put together, hence the plus symbols. And the speed with which it's changing and being adopted is breathtaking, right? And AI is fundamentally not an incremental technology. The cell phone, which took 20 years to go from military use to mass civilian use, was incremental. I could talk to someone in America with a landline. Cell phone made it more convenient. AI is not like that. AI is ripping up the rule book on what we think we know about computers. And I'm now going to talk about cars and trucks, which a lot of people confuses some people, but I would argue that rather than electricity and fire, motor vehicles are the best metaphor for what's happening with AI. So cars today are pretty important, right? They're woven into our personal life. We drive our kids to school in them. And that all started with the internal combustion engine. That was the novel innovation. And the first industrial sort of commercial sale of an ICE was 1860. Fast forward to today, cars are everywhere, largely thanks to Henry Ford and the Model T Ford, which came live in 1908. It took that harness around the engine for consumers to say, oh wow, this is cool, this is better than horses and buggies. And if you fast forward to today, in the US, 285 million registered motor vehicles, or $11 trillion invested, largely by consumers. Oil is one of the most precious commodities on earth, and we fight wars over it. People die because of the internal combustion engine. But none of that is the business play when it comes to internal combustion engines. That's the semi-trailer, or the Mack truck here. Today, 71% of goods by economic value travel on trucks. Right? Semi-trailers here, tractor trailers in America they're called. And ask Lindsay Fox about this. It's not trains, it's not boats, it's trucks, which is the business harness around an internal combustion engine. But trucks didn't take off and rewrite commerce and society and our economy until 2 other crucial enabling technologies came along. One was the shipping container, which was first introduced in 1956. The other were highways, which you don't think of as technology, but if you compare them to dirt roads, they sure are. And in America, that kicked off in 1956 with the Highways Act. When those things happened, roughly 100 years after the internal combustion engine, trucks took off. People like Lindsay Fox built fleets, and the economy changed, work changed, right? Everyone in this room drives a car, or knows how to. They got licensed, they studied, and you take it for granted. It's part of being an adult. And that is how AI is going to be. It's already like that for many consumers. Grandparents, like my parents, use it. 4-year-olds, like my daughter, use it. But we haven't seen the business step change yet, and that's about to happen. So let's go to AI. The core innovation in AI, the engine of AI, is the transformer model, or LLM. You've probably heard of this. And by itself, it's kind of useless. It was actually invented by Google in a paper in 2017. They gave it away and then slept on it for 9 years. But in November 22, Sam Altman launched ChatGPT, and that was the Model T Ford moment. Within 6 months, billion users of consumer AI chat. So we've had the consumer revolution around AI. Every consumer uses it in some way, shape, or form. We have not had our semi-trailer moment. We are about to. It's happening right now. It's been happening for the last sort of 9 to 12 months. It's starting to happen at scale, right? I'm seeing 50% of departments being laid off after we deploy AI technology to those departments. It's not our intended goal. It's the natural outflowing of what this tech does. And so the metaphor here is AI agents. So don't think about agents as AI. What you're using is consumer AI, it's chatbots, it's chatgpt.com. That's not what I'm here talking about. I'm talking about enterprise-grade, business-grade AI agents that work faster, better, and cheaper than most professional humans. And in this metaphor, data is the petrol. I'm very American, as you can tell, so it's gasoline, but data is the fuel that drives this new economy. So let's talk about agents more. Bill Gates says it'll be the main way we interact with computers. Satya Nadella, current CEO, says it'll be the primary way we interact with PCs. I go further. I say that AI agents will be the predominant way work is done, professional knowledge work, white-collar work is done soon. And it's a mug's game to say what soon means. In some companies, it's 6 months ago. In others, it'll be 6 months from now, 2 years from now, but it's happening. So what is an AI agent? I'm going to play a little video. For those of you who've seen The Matrix, you'll know this scene.
Can you fly that thing?
Not yet.
Operator.
Tank, I need a pilot program for a B-212 helicopter. Hurry. Let's go.
And then Trinity and Neo go and save the world. But in that clip, the agent is Trinity in the leather jumpsuit, right? In the physical world, she's in the crummy clothes on the ship and she can't fly a helicopter. But in the Matrix, within seconds, she gets that knowledge uploaded and now the augmented Trinity, human plus AI, can fly the helicopter and win the war. And that's what AI agents can do for all of you right now, right? AI agents can be loaded up with custom knowledge and skills, both, that can do most of your job for you. And that's amazing if you're creating them and controlling them. And it sucks if somebody else is creating them, controlling them, and replacing you. And that's sort of the crux of what I'm here to say. Everything you can do at a computer, an AI agent can, right? This is not ChatGPT. This is a different paradigm that most of you have not yet seen. And I don't want the time you see it to be when you're getting a pink slip, or when you're, if you're an owner or an investor here, when your competitors are running rings around you. You know, good AI agents can reason, plan, and act and delegate. They can even manage humans. There's a website now where AI agents hire human beings because humans can touch grass and AI agents can't. But that's real and now, and it's wild. Like anything, there are good agents and bad agents. This is too detailed to go into here, but the net of it is, if you're using chatgpt.com, you are using a bad agent. That's not what I'm talking about. If you're even paying $400 per month for ChatGPT Enterprise, you're still using a bad agent, okay? The tools available on the web are toys. They're consumer chatbots, and they're nothing but tech demos at this point, right? The really good stuff, Sam Altman doesn't want to talk about in public. He'd be hung, right? The only guy who's telling truth about this is Dario Amodi, head of Anthropic. And, you know, this is the comment I made about custom knowledge. Let's visualize that. A good agent has 50,000 pages or 20 million words of knowledge about you, your business, your customers, your issues, your problems, your projects, your tasks, your humans. 50,000 pages is 3 of me stacked in a vertical double-sided print, right? That's epic. No human can compete with this. And so then the senior professionals will say, but AI can't do my job. So let's go to the study where a team of extremely senior medicos from Johns Hopkins and Harvard and practitioners were pitted against a well-architected team of AI agents. Red team, blue team, each given the exact same data and tools and diagnostics. Now in the TV show House, the team of diagnosticians always cracks the case and saves the patient's life. But in reality, the humans, doctors, got the diagnosis right 20% of the time, 1 in 5. That sucks if you're the patient. And the AI using old technology, this is 2 years ago, they did this study, got it right 85.5% of the time. Which do you want diagnosing your disease? I picked the AI. And if it can do that in medicine, like my little sister, who's an endocrinologist, hates this, but I'd choose the team of AI agents all day, every day. And so if it can do that in medicine, it can do it in your industry. So let's take this to the boardroom. All of these mass layoffs are because CEOs and owners know what I'm talking about to be true. And it's because of this, right? Humans work a maximum of 40 hours a week, in Australia less, and that's at varying levels of productivity, only a sliver of that at peak productivity. Humans come with drama and words like overtime, and they're often a liability. And the great employees, the ones you find and train and get good, they leave you. AI agents, none of that applies. 168 is 24 times 7. Yesterday at this conference, I kicked off an AI agent job. It stopped today, 23 hours later. It did 23 hours of uninterrupted work, and that cost me about, I don't know, $50, right? I previously would have had a programmer who I paid 200 grand a year for to do that, and he doesn't work 23 hours straight. That would have taken a week, right? It's wild. And with agents, because they're code, you can press a button and go from 1 to 100. And I do, like right now I have agents doing work for me. And my little company of 10 humans, we're doing the work of, you know, it's at least a 5 to 1 in terms of what, you know, my whole company would have done. And AI agents, they never quit once you get them good, and they're scalable and saleable IP. If you create agents, either for yourself or for your business, that's IP that is extremely valuable in the new economy. And so if you're going to listen to anyone, listen to Dario Amodi. And the quote is, AI could wipe out half of all entry-level white-collar jobs, spike unemployment to 10 or 20% in the next 1 to 5 years. Most humans are unaware that this is about to happen. It sounds crazy and people just don't believe it. Believe it. Believe it. Right? Here's Joe. He's a junior partner at Accenture and he is stuffed. He's not a rainmaker, he's a delivery guy. Doesn't bring in revenue. He's got fancy degrees, so he costs a lot of money, like 300-400 grand. And he spends his time doing presentations, research, analysis, writing programs, you know, communicating. If Agentic Joe is put to work, which McKinsey and Accenture are doing, that's why McKinsey just fired 10% of their global workforce, the fanciest, snobbiest, elitist workforce on earth. Agentic Joe gets back 50% of his week, 20 hours in a week. And that means Joe's company needs half as many Joes. And that's with the tech today. And the tech today is the worst it is ever going to be. And so the Industrial Revolution comparison which people make with AI is real. I don't know what you see here, but I see a lawyer not using AI. That is a lawyer using an AI agent. The tract is the agent. And at least 5 other lawyers lost their job because that lawyer is using an agent. So don't be this guy. And in my field, in computer programming, this is alive right now. It's done. The debate is over. And everybody who's in it knows it. The modern AI coding agents from Anthropic, so Claude 4.6 Opus, came out a month ago, and Codex 5.3 from OpenAI, they just crush all human programmers. There are 27 million paid programmers on Earth, professionals, and we're going to need 5% of them. We only need the architects and the senior people. The rest can be done faster, better, and cheaper by AI agents. Now, that'll take years, and governments will fight it, and professionals will fight it. But it's here now. And Codex 5.3 built itself. That's the scary bit. AI is now building itself. OpenAI writes 95% of its code with its code. right? The pace will accelerate. And, you know, where do agents work today? The clue's in the name. It's data-heavy and word-heavy tasks, large language model, language. But almost everything can be reduced to language because that's how we humans work. And what this chart does is it plots work that is sensitive to errors, so the most sensitive work at the top, and AI aptitude on the x-axis. And so brain surgeons, they're safe because there's no tolerance for error. It's not wordy. But marketing, copywriting, I used to have 6 employees who just did these 2 roles in my company. Those jobs don't exist anymore. Advanced accounting, like as in strategic planning, that's still okay. Medical research, I should X that out now. This slide's about 12 months old. Most coding, already gone. Most legal, there, if you choose to use it, but the legal industry's been slow to adopt. But it'll happen, right? The capability's there, so it's just a matter now of adoption. So you can't compete, and you shouldn't try. Value has changed. If you measure your professional worth, or your company does, based on what you know, or how much you do in a week, you're screwed. You've got to rewrite the rules of the game. Okay? You don't actually need to be the victim of all this. What you need to do is understand what I'm talking about. Learn to create teams of agents. Learn to manage teams of agents. You learn how to manage humans. Do it again, this time with agents. By the way, sometimes they're a lot better than human employees. But be the agent builder, the agent orchestrator, okay? Or, I mean, I'm a musician, so my preferred metaphor is the conductor. I don't know what you see here, but I see a multi-agent system. 110 agents on that stage, each using one tool that we call an instrument. And up front is you, the person conducting that orchestra, not to write, you know, a legal brief, but to do something amazing. And for those of you who have companies that have missions that matter, like all of the deep science companies who are here, it allows you to do things at a scale you've never been able to do before. But I want you to, like, my challenge to you all is be that conductor. And I'm over time, so I'll throw this up, but like I said, you can get the slides from the QR code. You know, for ownership and investors, AI is incredibly amazing. For executives, it should be terrifying. For minority investors, most of them are sitting on the sidelines, sitting on dry powder right now, for good reason. Traditional competitive moats are gone. You can replicate ideas in days. So remember, AI today is the worst it'll ever be, and it's already better than us at many things. Agents make you superhuman. You can start operating at 5 times your own personal productivity with the agentic technology that's out there now. You can't compete with agents, so don't try. They work 24/7, 168 hours a week. You can't outwork them, you can't outknow them. But you can make them, and you can manage them, and control them, for now. You can't ignore this. Your job, your industry, your company, your competitors, it's all going to get completely, like, the script has been ripped up and it's being rewritten. And you may not know it, but it is. So I'd really encourage you to be part of who's rewriting the script for your job and role in industry. Next week, Thursday, we're going to do 1 hour on this with some practical sort of skills. My team will be showing people how to create AI agents, what I'm here to talk about. And then in June, we're actually running a full-day conference, Steve Dawson, my company. For those who were at the last AI Summit, it was a good day, and we're going to double down again in June. And so I'll leave you with 2 quotes, one from me and one from Dave Waters. From me, agents are amazing for bosses and owners, right? They're terrifying for average people. For God's sake, don't be average. And from Dave Waters, master AI before AI masters you. That's it.
Thanks, Ken, for those insights about AI. Before you head out, I want to remind you again to subscribe to our Capital HQ YouTube channel for more capital raising insights straight from Steve Torso, expert deep dives into AI, and exclusive walkthroughs of the Capital HQ platform. Enjoy your lunch, and we will be back here at 1:35 p.m. sharp for our next panel session. Thank you. Welcome back, everyone. I hope you all enjoyed lunch. We are kicking off the afternoon with a look at the future of finance. Please welcome our experts for the Digital Asset Investment Trends panel, starting with our moderator, Steve Torso, CEO and co-founder of Wholesale Investor and Capital HQ. Our panelists, Kate Cooper, author of Edge, a field guide for adapting, performing, and leading on the edge of tech-driven change, and she's also the CEO of OKX Australia. Pratik Kala, Head of Research and Portfolio Manager at Apollo Crypto, and Effie Dimitropoulos, CEO of AUDD. Let's all welcome them on stage.
Welcome everyone, this is the fun session. You probably might have noticed from all my content, I've got a slight liking of crypto over the last over the last few years. So look, obviously I'll get the panelists to give a quick introduction, then we'll dive right in. So we'll start with you, Effie.
Hi, I'm Effie Dimitropoulos, CEO and co-founder of AUDD Digital Stablecoin. We've been in operation for almost 4 years and have been transacting in the areas of payments, cross-border, settlements, treasury, and have to date transacted over $1.5 billion. And we believe that we are on the future of finance and acting as the infrastructure and digital rails for what's to come in the near future.
Hi, my name is Pratik Kala. I'm the portfolio manager and head of research at Apollo Crypto. We've been running wholesale funds and even tokenized funds right now for the past 8 years. Aussie fund manager with some offshore funds as well.
And hi, I'm Kate Cooper. For those of you who didn't see me in action this morning, I'm CEO of OKX Australia. OKX is on any given day around the second largest exchange operating in the world with 200 million users. Relatively new to Australia, we've been onshore for a couple of years and uniquely for an international exchange operating in the licensed capacity in Australia, we have a really strong team on the ground of Aussies. So 30 of us are based down in Castlereagh Street, and that's really important in terms of making sure that what we offer is relevant to the local market, not just a cookie cutter of a global exchange capability.
So Kate, we'll start with you. One of the themes I talked about yesterday in my keynote was the institutionalisation of crypto. So obviously, being one of the largest exchanges on the planet, you sort of had first-hand insight as far as what you're seeing, as far as the questions institutions are asking, what are they looking to do, what family offices are looking to do. What are some of the most significant trends that you're seeing at the moment?
Yeah, listen, I mean, that institutionalisation trend, I think it's if last year was the year of the stablecoin, I think this year is the year of the institutions. And obviously, the regulatory environment globally has really influenced institutional adoption. I remember I used to head up digital assets at NAB, and the number one excuse that people would use as to why we shouldn't do anything in crypto was because the regulation wasn't clear. So regulatory clarity really helps to give institutions the parameters within which they can start to participate in this space. And obviously we've seen the US really lean into that with Genius and upcoming clarity. But also here in Australia, we have specific regulation that is going in front of Senate on the 16th of March and has broadly bipartisan support. So we're expecting that to go through relatively quickly. And I think that means that the superannuation funds, definitely our conversations with them have ramped up significantly. All four of the big four banks are participating in this space. And it's very much kind of, rather than speculative activity, which maybe has characterised the last 5 to 10 years, we're now seeing kind of more governance-led activity. For example, we partner with Franklin Templeton and offer their tokenised money market fund. We partner with Standard Chartered and work with them from a bank-grade custody perspective. So really we're seeing the big players not just testing and learning in a death spiral of pilots, but actually putting material investment into the infrastructure.
And just to, I suppose, give clarity, why is the Clarity Act so important? Like, why is the commentary around how there's pretty much billions of dollars of capital lining up to come into the space once that actually gets through?
Because with clarity comes certainty, and I think it provides the guardrails, and without the guardrails, and America, for better or worse, has a ripple effect globally. So it's definitely influenced the speed at which regulation has been introduced here as well. So it's that kind of lack of ambiguity that really gives the market the confidence to start to participate more meaningfully.
And Pratik, for you, I suppose the question I have is, if you think about, we started seeing our first ETF products, over the last couple of years, which meant that pretty much everyone through their CommSec account can get access to Bitcoin. And you start to see a lot more money flows. We're seeing more listed companies holding Bitcoin and crypto on their treasury. So then the question, I suppose, becomes, and this is one for me personally, and I suppose everyone's wondering, is why is Bitcoin down at the moment?
Yeah, great question. I think everyone's thinking that the industry got everything they wanted. We got clear regulations. We got hundreds of ETFs globally, not only in Australia, but in the US, in Europe, everywhere else. We also got a lot of digital asset treasury companies buying billions upon billions of Bitcoin. So why is Bitcoin halved from the last year? There are three main reasons for it. The first one is old holders, large whales, have sold. Why did they sell? Well, it's because it's the first time in history that they could sell in size and in volume. So there's credible on-chain evidence that billions and billions of dollars of Bitcoin was sold in the second half of last year. And they could do it because of the deregulation. Prior to that, if you wanted to sell Bitcoin in any volume or size, your bank accounts were going to get frozen. The FBI would come knocking on your door saying, hey, what's this? How do you have so much money? So one of the reasons is a lot of these people were early to Bitcoin. They made a lot of money. They did 100, even 1,000x. And it was a period in their life where they're like, okay, it's time to maybe cash out on this enormous gain that I've had and the pain I've suffered over the 10 years with Bitcoin being an extremely volatile asset. The second reason is a lot of Bitcoin miners have started selling Bitcoin or sold Bitcoin and are also selling forward Bitcoin, so Bitcoin that hasn't even been mined yet. The reason why is because of AI. AI came in and Bitcoin miners have an infinite amount of energy. They have energy contracts in place. They have all the infrastructure ready, and they have everything set in place for AI to come and plug and play. So a lot of the AI companies, hyperscalers, came in, threw billions of dollars to the Bitcoin miners and told them, hey, can you convert some of your mining operations into powering NVIDIA chips? And so a lot of the miners did, but a part of the deal was you have to sell some of the Bitcoin on your balance sheet to fund this because we're not going to fund 100% of the transition. So a lot of the miners were also selling some of this. People think that's bearish Bitcoin, but the mining hash rate, which is the security of the network, has been going up and is up a 2x from 2 years ago. So it's not like it's a temporary sort of thing, but the network is still healthy. And the third main reason is 10/10, as they call it in the industry, which is the 10th of October. There was a flash crash in the industry. A lot of the assets and very large exchanges, assets dropped 30 to 40%, in some cases even 99%. And because of how prevalent cross-margin is within our industry, there was widespread liquidation across many, many funds, market makers, and other sort of players, which shook the confidence in market structure and the market structure for a lot of players. So liquidity has dried up since then, and it's one of the other reasons that Bitcoin's been down. So it'll take some time to restore the confidence.
And Effie, for you, obviously, Kate just mentioned about last year was the year of the stable coins. You hear things where you're talking about Tether, churning out $15 billion worth of profit with 300 employees. The value of each employee being like 1.6 billion as far as for. And it's obviously become a new business model. And so just to help people understand, I said there has been commentary from the CEO of AirWallex where he said, I can't understand the use case for stablecoins, and obviously it naturally impacts his business. But from your perspective, how are family offices, how are institutions, how are even companies using stablecoins?
Yeah, thanks. And thanks, Pratik, for that rundown of that. I haven't heard it in such a nice summarised version. And In a way, I'm going to talk about something very boring. Stablecoins are a little bit boring in the fact that they are infrastructure and they are rails and they are facilitators for online and on-chain activity to occur, and certainly within real-world asset space and in the investment space. So people aren't buying a stablecoin to invest in, to make money in. It is not an asset class that is considered, oh, what am I going to invest my money in? Stablecoin, certainly not. It is a way to get into the investment space. So what I mean by that is, when we're talking about real-world assets as an example, real-world assets are programmable versions of something that's real-world, which means that if it's already programmable, how do you interact with a programmable asset with something that's not programmable, which is money? How do I get traditional money into the system when I am buying a fraction of something? I can't give a fraction of a dollar or a fraction of a cent, but I can do so with a number of programmability criteria with stablecoins. So in terms of where do investors participate in stablecoin capabilities, it's more so about how to easily get in and out of the ecosystem, how to get into these ETFs and into the funds that Pratik and Kate are talking about, and it's about ensuring that you're not using your volatile investment crypto capability and today, spending $1 million of your, or let's say 1,000 of your crypto dollars as opposed to 1,000 of your known Australian equivalent value dollars to invest in this asset to make a return. So it levels the playing field in terms of understanding how someone can get into the digital ecosystem and stay there at a very low risk level.
And I suppose it's for the entire panel. If you think about sort of everyone here, I'm sure the majority of us have some sort of crypto holdings, or for some looking to extend. If a high net worth or a family office is looking to allocate 5 to 10%, of their portfolio to digital assets, how should they be thinking about it? And I suppose from a broad perspective, should they be thinking about direct? Should it be through funds? Should it be in stable coins? How do you think about it? Start with you, Kate.
Yeah, happy to. I mean, obviously, I'm an infrastructure provider, not an investment advisor, so I couldn't tell you how to allocate your 5 to 10%. What I can do is kind of think about the kind of framework that you should be using and think about the considerations that you should be making. You talked, Pratik, about liquidity and the liquidity drying up, and I would certainly be looking at the liquidity behind the assets that you're considering investing in. Obviously, there's volatility, and if you think about crypto, it's a spectrum. At one end, you've got kind of the meme coins, the Trump and the Melanias, and the others you've got like Bitcoin and then even stablecoin, which is the stable end. And so really it depends on your risk appetite, what your documented investment strategy is in terms of where on the spectrum you decide to participate. Overall, I think anyone, no matter what investment strategy they're deploying, would like their assets to remain safe. So custody is another major consideration. In addition, in Australia, the legislation that's coming out is going to require any crypto exchange to hold an AFSL. We currently do. At OKX, we're one of only 2 who actually hold an AFSL at the moment. Obviously, everyone else is applying. But it just means that we're required to operate within ASIC's purview, which means we have to invest significantly in our AML-CTF capability, compliance capability, all of which is actually designed to protect you as an investor. So those are some of the things I would be looking for when I'm thinking about where should I allocate.
5 to 10% is quite aggressive, I must say, but that's good. If you would like to have it, I've personally got over 90%, so I'm down. Very committed.
What's that defined as? If 5 to 10% is aggressive?
For most investors,
Insane.
my risk tolerance is much higher, I would say. But 5 to 10% is not out of the, is not wild anymore. Last year, Bank of America, Morgan Stanley have greenlit all of their financial advisors, and they've got tens of thousands globally, to be able to invest 4%, up to 4% of their portfolios into opportunistic sort of crypto, into opportunistic portfolios into the crypto ecosystem. Just the year before, it was 0%. Basically, financial advisors could not even pitch crypto products to their clients because they weren't insured, and there were lots of problems with that. So seeing two of the largest wealth managers globally turn around and advise to allocate up to 4% to crypto is a huge turning point. Now, how do you want to invest it? If you're a vanilla person, doesn't want too much risk of volatility, you can easily buy the Bitcoins. They're only 12 basis points or 15 basis points of fees every year. There are plenty of them, so I won't name which ones, but the largest issuers have them. And in Australia, I think 4 domestic issuers have them as well, if you want it in Aussie dollar exposure. And then if you want to invest in the frontier part of the crypto market, then obviously there are funds like ours. So not only do Bitcoin and Ethereum, but the rest of the crypto ecosystem is rapidly evolving and changing. And there are many, many coins and tokens that we believe would transform into the Mag 7 or the Magnificent 7 in the traditional world, but in the crypto world, that can really transform the way we do business. And we're not alone in that thought. Just last week, BlackRock and Apollo Global, not Apollo us, but Apollo Global, the large private equity firm, ended up taking some positions in some of the crypto tokens, which is the first in history. And the industry's been around for 15 years, but it's the first ever. So I think we're turning a corner. And for altcoins, it's funds like ours. Otherwise, ETFs, low fees, easy access.
Well, you're missing one part, because you also have the ability, like people coming into Apollo, they've got the option, like you said, for the sort of the tokens, the frontier tokens, but also the yield strategies as well. So speak to that a little bit, how some investors may be approaching, whether it be the growth tokens that they could be going into and also the yield plays.
Yeah, thanks. We have 2 main funds. One is growth. So if crypto goes down 50%, we will go down with it. Obviously, not in the equal percent because it's an actively managed strategy. The second strategy is a delta neutral strategy. It's a fancy way of saying we harvest the yield in crypto. That's been, just plugging in, last year we were the best performing fund in Asia Pacific for the delta neutral fund. We returned 17% net of fees. A neutral fund over here is just harvesting yield in crypto. It's a neutral strategy whereby you never have directional risk. Crypto can go up or down or can blow up and stuff and will still be neutral. We'll just be harvesting the yield. And so that's a very stable strategy for a lot of people in the bear market. And we're seeing a lot of people switch from the growth fund to the neutral fund because 15 to 16% in USDC or US dollars is quite attractive. And way above market for other sort of private equity firms and yield funds. And we provide almost monthly liquidity as well. So easy to get in and out of, and superior yield compared to many of the other offerings, and more transparent.
And yourself, Effie?
Similar to Kate, where we are infrastructure, we're not providing opportunities for people to invest or partake in that capability. But what I would say is very strongly support the idea that if you're an Australian investor and you are looking to commit 4 to 5% of your portfolio into this environment, absolutely look for those trust metrics and trust triggers. AFSLs are important. We're an AFSL regulated stablecoin issuer. Make sure that you understand what the custody of your funds and where they're sitting and who is managing those funds. Understand what licenses the operators that you are dealing with need to have. I mean, I know that I've certainly been approached by international funds saying, "Oh, you invest your money, you'll make this." It's like, who are you? Why are you contacting me? So do that research. Make sure that you do speak to reputable players. We've got 2 on the stage here, right? And so make sure that you are going in with your eyes open and ensuring that you are keeping yourself protected by looking for those metrics of regulatory governance, compliance that any of your operators are providing you.
And Pratik, when you mentioned before, obviously Bitcoin going down sort of 40, 50%, and obviously the altcoins going down more. How do you change your portfolio structure during periods like this?
Yeah, it's an extremely volatile period. If you look at the altcoin ecosystem, which is coins outside of Bitcoin, the average in the top 200 is down 78% last year. So it just tells you the bifurcation of the good assets versus the poor assets. There are 20,000 crypto tokens out there. As I've always said, that 99.9% of them are completely useless. but there are a few that will change the future of finance. We are seeing a lot of traction in real-world asset tokenization, and as I mentioned, the likes of BlackRock and Apollo taking positions in particular tokens because they are servicing that. In order to, the portfolio construction before last year was admittedly a little bit in this basket, a little bit in that basket, and all of that. It was still blue sky thinking. A lot of crypto protocols were not making any revenue. So it was a little bit of a venture bet where we hope that they would be able to make it in the future. But now it's completely changed. Now the portfolio construction's completely shifted to actual cash flow generating crypto tokens, of which there may be 7 or 8. Right now the portfolio is completely pivoted to tokens where we can ascertain the amount of money that they're making, their expenses, and how much they're using to buy back their own token to distribute revenue in some shape or form. In the past, a lot of crypto projects were tainted. They made a lot of money, but they never gave it back to token holders. They spent it on various different things. But now I think the serious people and the funds in the industry are pushing all the founders, saying, no, that's enough. Show me the money and show me how that money translates into your token price going up. So portfolio construction now is a very concentrated portfolio of assets that are doing that. And again, there are about 7 or 8 only within the entire ecosystem today.
I was just going to add, exactly what you've described is really, for me, evidence of just how the industry has matured so much. And this is why we're seeing kind of institutional inflows, because the level of rigor, the level of due diligence that is being applied across the industry now is certainly bank grade. Actually, probably I have more bureaucracy at OKX than I had at NAB, because we really take it seriously. So I think it's those kinds of examples are examples of the way in which the industry is maturing.
And I think that maturity almost translates to something I said a little bit earlier, where it becomes just a little bit less exciting as the crypto world used to appear to be, where it is going back to fundamentals and basics. I want to understand what the returns are and where the gains are, where the losses are. It's not just about being totally, I'm going to make 100x and that's where I want to get in. I now see the investment community more so looking for that capability from where they're purchasing from, and also what the funds are offering. They're basically putting all that out there to say, yes, not only are we doing this with crypto, but we're almost doing it better than bank grade in a lot of ways, because we have to constantly prove the credibility and the reputation and the trust to ensure that we are a viable industry moving forward.
Yeah, just a quick note on that as well. The funds that were taking that 100x approach and all of them, there were a lot of unsophisticated actors, so I would say. In the industry, I think 80 to 90% of them have been wiped out. So, we've been around for 8 years. Only the real ones that applied proper investment rigor have survived, and hopefully will also capture the next wave of upswing.
And Kate, I suppose a question for you, obviously, from an exchange perspective, how do you see, whether it be family offices or whether it be institutions, in these periods of volatility, how do they use things like options and futures, et cetera, to, I suppose, assist with their downside protection to manage their portfolio?
Yeah, listen, we're definitely seeing an increased activity in those spaces. I hate to sound incredibly boring. And to your point, Effie, a 50-year-old grey-haired lady is not what you expect to be a CEO of a crypto exchange. But, we very much kind of take a governance-led approach, and we're seeing our clients take that approach too. Of course, yield is still incredibly important, but I would say it's a 50-50 consideration now. And so very much we're seeing a much more thoughtful look at investment strategies, not just from our high net worth and family office clients, but across the board, even our retail clients.
And Effie, for you, obviously in the area of stablecoins, there has been, in the past there were some blow-ups. There was a lot of speculation around Tether for a long period of time about the sort of matching reserves and transparency. How do you approach that from an AUDD perspective?
very seriously. When we modelled the whole business over 5 to 6 years ago, we looked at best practice. So the experience that came with, my background in operating alternative finance products across multiple jurisdictions, and including licensing in everywhere from South Africa to UK, Europe, New Zealand, Australia, Canada, all those sorts of places. So you look at the best practices of how value is treated within those markets and how to best protect monies, consumer monies, segregate funds, manage the reserves well. Look at best practice. The only best practice at that point in time was Circle. So certainly we looked at how well Circle was doing and what governance approach that they had taken. And in the absence of any regulatory clarity in this country for a long period, we imagined that, of course, regulation will come at some point. We wanted it to appear in some guise. And so we modelled the whole business, the whole service offering and the delivery in such a way that it would stand up to scrutiny from regulators, to scrutiny from authorities, from scrutiny from consumers, to ensure that their own monies are protected. So in terms of managing those reserves, currently we actually at this point are only doing cash equivalents in tier 1 banking providers in Australia. So onshore money, not rehypothecated. It is in bare trust. It is only for the use of holders. It is not commingled with operational funds. So AUDD holders' money is totally separate to AUDC Proprietary Limited's money. And certainly, Kate alluded to the fact that how is the custody and how is the reserves being managed. These are the topics that we deal with and look at every day. We talk to regulators about how we believe best practices should be and what best practices around the world look like, and we help to inform some of those discussions and those decisions, and to ensure that we aren't a stablecoin issuer that doesn't stand up.
And for Prateek and Kate, obviously one of the biggest threats, that goes to exchanges and goes to fund managers around the sort of cyber security area. Just give everyone a bit of an understanding, sort of, how you, I suppose the risk measures that you guys take internally to protect people's money.
I can start. Yeah, we are very active on chain in crypto. In crypto, everyone's heard about wallets being hacked, rugged, somebody logged in, all their money's gone, and all of that. That happens a lot. And obviously, we've been running funds for 8 years. Our operational processes are pretty airtight. When you're interacting on chain, you can always whitelist addresses, so people can't just take your money and disappear. It's like whitelisting addresses in your bank account. You cannot transfer money, or nobody can pull money out if it's not whitelisted. We use custodians like Fortify. They provide a whitelisted directory of protocols that are safe to interact with, but then additionally we will also verify through third-party providers to determine which ones are safe. And of course, every transaction over $10,000 has 3 Face IDs in our team. So it's a Face ID from me, a Face ID from our CIO, a Face ID from one of the other team members before it gets through. So just because someone's accidentally gotten access to the wallet, it's not like they can drain the money. It has to be there, 3 different geographical distancing with Face ID tied to our phone, which also requires a unique sort of USB key to operate. So lots of security players like us have in place to protect our investors.
Yeah, I mean, I don't want to repeat what you said, but I think that other things to think about are like what's insurance is in place. That's obviously something that OKX has a really strong insurance fund should anything ever go wrong. Segregation of GTs and segregation of those assets. The custody option that you choose, obviously cold storage is the safest from attack because it's offline, it's actually not connected to the internet, but with that comes quite a lot of complexity in terms of your management of your keys. So a lot of our clients decide to use our custody solution. We hold proof of reserve, so we hold all assets 1-to-1, and you can see online at any given moment those assets and where they're held. So from a safety, security, fiduciary duty perspective, those are some of the things to look for, in addition to all of the cybersecurity processes that you've discussed, which are absolutely a core part of the platform.
And certainly certifications with governance frameworks, whether that's ISO, whether that's SOC 2, additionally reserve reports by third-party audited operators. So, for example, at any one time, you can go to our website and see exactly where the monies are held and are they held one-to-one. As part of our AFSL licensing, there is requirement to hold a little bit more than one-to-one, and that's what we comply to. So, but certainly, I think all of the above that everybody said is just the ability for newer operators in the space rather than traditional operators who maybe have legacy systems that are very hard to bring up to speed. We've been a little bit more nimble in being able to execute all of those transaction monitoring measures and compliance measures and security measures built in and baked in from the beginning. So, that gives a little bit of assurance to everybody.
So my final question, this is something that I endlessly think about. Personally, I keep on thinking, what is the future of everything right now, just because everything is moving so fast. You mentioned about the convergence of S-curve, all the different S-curves. You mentioned it specific to crypto. I mentioned it across all the different areas. You as an investor, Pratik, you talk about architecture and sort of, being the platform operators. What do you see as the future of finance how does that evolve over the next 3 to 5 years? And what should everyone in this room expect to see? Outside of the traditional banking that we all understand.
I can start. I think a lot of people in the room may not know, but the tokenization of funds is going to change the future of finance and how all of you guys invest in the future. It's a buzzword. A lot of people talk about it. I'll give you a practical example of how it works. We run a tokenized fund, disclaimer, not investment advice, and there's things you have to read before you invest.
What a nice time to throw that in.
But we run that right at the moment. The benefit of this is, historically, if you came into our wholesale fund, say you put in $100,000, that money was locked in the fund until you redeemed. So it was just locked there. You put in 100,000, maybe it's 150 next year. You can't do anything with it. It's locked. We now run a tokenized fund with the same strategy. You can now invest the same $100,000, and if in 3 months you decide that, hey, I want to take a $20,000 loan against it for some short-term cash flow needs and all of that, that loan could be provided to you in practically 5 seconds. When I show this to traditional fund managers, they're just like, wow, because that just changes the capital efficiency of how you use your money and manage your portfolio. It's not that I've given money and I'll redeem in 5 years and that money's I can't use it again, I can't draw against it. Now you can get it in 5 seconds at very competitive interest rates. And that's exactly why BlackRock and Apollo Global are coming into the space, because they now see it. And now we've also got regulatory clarity that, okay, now you guys can do this without the government breathing down on your neck. So in the next 5 years, you're going to see a lot of this and a lot of huge shops offering these, that, hey, you can invest in us, and if you ever want to draw a small loan, we can get it to you within 24 hours. I mean, in reality, it can be done in 5 seconds, and we do it every day in our fund, in our new offering. So that's going to change finance radically.
So to add some numbers to that, I can't remember the exact what it's at now, but it's in the sort of low billions at the moment, but it's expected to grow to something like 10 trillion over the next sort of 4 to 5 years, to give you an idea of that growth in what you're talking about.
Yeah. I mean, you have to see it to believe it. We do it every day. It's just like, there's no other way I would invest. It's just one of those things. You're just like, hey, I can invest, and if I want to redeem a small portion, I can, and it settles in 5 seconds. I don't have to worry about paperwork and waiting for 7 days and all of that. So it's radical, and it works, and it's going to change the way finance works in the next 5 years.
And Kate, for you, obviously, OKX, is such a leader in the building of the wallet infrastructure, and obviously everyone knows you for the crypto exchange part, but there's been a massive investment on the product and the wallet infrastructure. So I'd love to hear your thoughts on this.
Well, I think so. We'll be launching Pay and Card soon, and we've been launching it in countries like Brazil and Singapore. And what does that mean? Like that, it's bringing together like what is seen as like quite a traditional way in which everyday consumers interact with the finance system, but then using the on-chain technology to provide instantaneous, low-cost transactions. And so I think that what we'll see is the convergence of the traditional finance and the decentralized finance, such that you actually probably won't even know what's powering behind your transactions. You'll just know that they're quicker, cheaper, more efficient, less counterparty risk. And I think that's one thing. I think the second thing is, and you've touched on it already, Pratik, but tokenization of real world assets really is has moved beyond theory and is now moving at pace. There's a project going on in Australia at the moment called Project Acacia, which is being run as part of Reserve Bank of Australia. And one of the really interesting elements of that project is the tokenization of government bonds. And so for the first time, not just the high value investors will have access to those kinds of assets. In addition to tokenizing, I was having a conversation last week with someone who's tokenizing his wine cellar. And, he's got amazing wines in his wine cellar, and he's going to tokenize it and provide kind of investment access to others for that. So there's, a lot of diversification of the way in which the technology is going to be deployed.
And that's a fantastic example as well, because once you tokenize wine, historically, it's like, okay, my money's locked. Maybe I'll get it in a year or two. It's illiquid, it's locked. Once you tokenize it, you've got shares, you can swap it, you can lend against it, and you can get, as long as there's a willing lender, you can get money against it in 5 seconds. So that's how people start changing their thinking about how they invest and how they construct their portfolio. So it would be quite positive.
And for you, Effie, obviously in your area is almost like the future of what banking can be. So.
Yeah, but I do see the future very, very similar to Pratik, Kate. My word would have been definitely convergence, and I think the convergence will be from the traditional and to the crypto sector coming together, and for the consumer and the business community being able to access in one place. And dare I say it, I do believe that crypto exchanges like OKX will be not only the banks of the future, but certainly investment portals of the future as well, because you would be able to, as a consumer, do all of the things, Kate mentioned, card, payments, wallets. You can access fiat, you can access crypto, you can access any real world asset. You want to invest in wine, gold, you don't know how to do it today, you go to your one platform and all of these things are available and can make that happen for you at $10 or $1,000 or $1 million. It won't matter anymore, because they'll be the trusted infrastructure that brings all of those activities together under the one roof. And people like myself, who are operating infrastructure and Rails, will be backbone to these systems and services, enabling sovereignty of Australian dollar funds for Australian consumers in our case. But certainly from a future, I think it is a much more global future than it is even today.
And my summary would be, if there's two things I've learned when it comes to innovation, is anything that saves time, saves money and improves efficiency ultimately wins. And the second part is when you're seeing that S-curve adoption, the first nature of innovative products is they will match the incumbents, and then they typically accelerate and blow past it. So, ladies and gentlemen, that concludes our Digital Asset Investment Trends panel session. Please give a round of applause to the moderators.
Thank you to our panelists for sharing their expert insights. Our next presenter is addressing a critical gap in the Australian security market. As traditional banks pull back on physical services... Oh, the script has been cut off. Anyway, let's just welcome the founder of Kavach, Dinesh Dindukurti.
Good afternoon, everyone. What a great segue. From digital assets. Oops. Sorry, is this better? Can you guys hear me? Yeah, lovely. Great segue into my presentation from digital asset to the physical asset productions. But I'm not going to talk about the investment trends. Instead, I'm going to talk about the production of those physical assets. All right, what is Kavach? Kavach, the word originates from the Indian Sanskrit, which means a shield or production. So we're going to apply the same philosophy in protecting the physical world in Australia. So we are building an infrastructure-grade, secured storage systems to protect the physical world.
Some people hide gold in sugar jars. Others keep cash behind the broccoli because it apparently makes great security. And then there's home to all important things. Safe? Not really. Because Australians know life can change in a heartbeat. Bushfires, floods, storms, break-ins. We insure our homes, cars, but what about the things a policy can't replace? Your wedding ring, your grandfather's watch, inheritance jewellery. And even when you try to do the right thing, it's not easy. Long waiting list for lockers, inconvenient trips into the city, limited hours, all just to access what already belongs to you. Because insurance can replace objects, but it can't secure emotions. Meet Kavach, Australia's tech-driven bank-grade vault network, right in your neighbourhood, with biometric access, AI-powered surveillance, blockchain-verified security, because Kavach protects what matters most, not because it's expensive, but because it's priceless.
So I'm sure most of you have an idea of what I'm building now. So want to go. Yeah, the main problem that we have in Australia is, we have. Sorry. Right. So we have. It's cutting down. We have a huge increase in the break-ins at the moment. Year on year, it's growing at the 17% increase rate. It's pretty scary, and people are not. Very vulnerable to stay the gold and jewelry at home. So that's where we come in. And the current vault storage facility is in the CBD area, right? It's great. There is a great security, but apparently it's not accessible for most of us as the suburban world has moved onto the suburbs. The world has moved onto the suburbs, right? So that's where we've identified, there is a huge gap. When running through the numbers, for one storage box, there are about 82 families that are waiting, which is a scary number. And apparently, when you compare with the other numbers, yes. So with this, right, when you compare with the other matured nations, the numbers are pretty staggering. There is a one storage box for every 32 families, and which is causing a high break-ins in Australian suburbs. As I said, the world has moved to the suburbs, but the security hasn't. And that's the reason why the increase in crime rate. So we have a 4-pillar solution. We are going where the customers are living. So we are building a suburban vault network in the suburbs. And we are going to integrate a digital layer. We are going to use the digital blockchain. And we're also integrating mobile app integrations as well. And we're also doing the AI surveillance. Apart from that, we are catering what customer needs, which is extended hours. At the same time, we have a family structure. Just to give an use case, so if myself, I operate the locker, my wife gets a notification saying that somebody has operated. So which means that you have a security even when you are not in the vault network. And currently, we are converging all these ones into the one solution. Yeah, as I said, this is the stats that proves we are way behind when you compare with the mature market. So our goal is to improve the box to family ratio by 1:60 in the next 5 years. Our business model is pretty simple. We'll have a rental revenue coming. 85% of the revenue comes from the storage box rentals, and we'll also have a subscription. It's a recurring revenue, and we'll have a premium add-ons. One of the ideas that I had was, to get as we are developing the private blockchain, we wanted to tokenize that one too. That is in the pipeline of works. And we're also working through the insurances as well. We'll have the remaining percent with the insurance commissions too. So the primary revenue, 85% of the revenue comes from the recurring rental revenue. All right, why now? As I said, we have a rising suburb, crime rate, and the cultural wealth is very concentration in the suburban areas, and more importantly, the banks are cutting down the branches. So they're cutting down all the vaults. To give a stat, ANZ has cut down all the vaults in 2029. And there was no new vault set up in the last 16 years in Australia. But our population is growing at a rapid rate. And taking into time, the Melbourne market size, just looking into the market size, we are with the TAM size of 108 million. With the SOM size, we are targeting about 4.8 million, which is obtainable market. And why now? There is no direct moat at the moment. We are ticking all the boxes. The Kavach is uniquely combining all the institutional grade security and at the same time digital trust as well. We are adding a digital layer. And currently, the CBD vaults, as I said, they're very concentrated in the CBD. And the self-storage, they're accessible, but they're not secure enough. They don't come up with an insurances and all. And Kavach is only operated at the moment. We are building both physical security and digital security. Hence, we are uniquely combined. Let's talk about the unit economics. The revenue breakdown is, as I said, we'll have an annual subscription, the casual hire, and the digital vault, and the insurances and the premium services. And we are forecasting an annual EBITDA about 54% with a 70% utilization with our initial facility of 3,000 safety storage boxes. And our capital can be fully recovered in under 4 years. And here is our 5-year outlook. We're going to start our initial flagship storage facility with 3,000 boxes, and we'll slowly upgrade into the 4,000 boxes. And but with this approach, we are de-risking the demand and before we expand it. And we're also planning for the national expansion in the next 5 years. Our aim is to set up 2 facilities in Melbourne and 4 facilities in Sydney in the next 3 years or so. And we're going to go global. And our goal is to serve 75,000 families in the next 10 years. The team, we have a strong team. We are 4 pillars and 4 core team. I'm founder, and I bring over 20 years of experience in building infrastructure projects for both government and state organizations at large level. Come with a cybersecurity and ICT space background, and I have a proven track record of providing the projects in time on dollar. And Anand, who is my operations head, he has an experience in leading. Sorry for that. Yes. I'm going to skip. And we also have Michelle Maxwell as well, who is on board, who is an insurance partner. I'm really sorry. And yes, Kavach is all about protecting the legacy and creating a new security standards for suburban Australia. So let's together build a future safe suburban storage facility for suburbs. Thank you very much.
Thanks, Dinesh. And that was Kavach, Australia's first AI-powered suburban vault network. As we shift our focus to the world of structured capital and funds management, our next presenter represents a firm built on the pillars of discipline and execution. SUMO Group is an emerging funds management platform that bridges the gap between private wealth and high-quality structured investment opportunities. Please welcome the founder of SUMO Group, Suren Patter.
Good afternoon, I'm Suren, and welcome to the graveyard session of Emergence. I've had to dramatically change my talk, by the way, because I look around in this room and I have a lot of sympathy. A sympathy because many of you have been here for the last few days. You've heard some brilliant talks, lots of new ideas, and you're totally confused how to choose how to invest your money. But at the same time, a lot of promoters around here done a great job with great ideas, and you want to recruit capital from the same investors. And unfortunately, to do so, you've got to sell yourself and tell them what they need to hear to try and get their money. So I'm here to solve all of your problems in this room. So how do we do it? I've got to figure out how this works firstly. If I press the wrong button, don't worry, I won't need the 8 minutes, by the way. Which button do I press? The green? Okay. We have to have a disclaimer. I'm used to this because of the next picture. I've got a bit to tell you about ourselves, what we actually do, and how we solve your problems, like I've said. So who are we? We started in 1992 providing advice to high net worth, high income clients. We specialized in financial planning. I was one of the very first certified financial planners, heavily involved in the profession, but I saw money as just a means to an end. And when clients reached that financial freedom, they were lost. So we created the first journey for clients to take them through the key aspects in their life, because everyone in this room will be affected by one of three things: money, relationships, and health, period. And so we helped them through the journey to become financially free. But one of the biggest problems we saw every single time as a financial planner, and we were let down by one thing. And just to help you understand the one thing, it's like going to a good doctor. You get the best of advice, but a doctor is useless without the prescription. And that prescription was the financial product. Now, I must say, and thank you all in this room, by the way, to you, I've had some great lunches, great holidays, great travel, all on your behalf, because you're paid for the very products that sponsored my lunches and dinners and looked after me well. And they were great products, don't get me wrong. Big companies, great brands. But at the end of the day, as much as I enjoyed it, to my clients, they just got an ordinary return. An ordinary return. So my frustration led me from this big entity I created since 1990, where I had more than 400 employees and consultants working for me, and to now I have only 3. Emerging Funds Management was only created a few years ago, and in fact in the last year or so, within the 3 years, we won Fund Manager of the Year, Property 2025. Just because of 3 highly capable, highly qualitative people. Dr. Susan Saunders, a doctorate in accounting, spent a lot of time looking after digital firms, creating some very unique processing and ideas, in fact using series accounting, etc., to make sure there's equity to investors investing in these funds. Dr. Roger Buckridge, my co-founder in Emerging Funds Management, they call him the father, I call him the grandfather of venture capital. Been through many businesses, understood many businesses, but is very focused on compliance and governance. So together with this team, we've then gone into looking at product design and creation for sponsors. That means anyone who has a great idea or wants to raise capital from the public, we create these financial products for them, and we then take it out to market. Now, we are ASIC regulated, but the difference is we get our clients to pay us to choose them. Now, how do we do that? We're purely fee-based, where they pay us to assess their idea, corroborate it, verify it, before we take them on as a client. That's the difference with you creating your own product and going out there and selling it to investors. You have an independent party assessing the feasibility of the project or the underlying business. Once that's done, and once we believe in it, and by the way, we reject 90% of the sponsors that come to us, we then write a story independent of the sponsor that's ready to go to market. That's when the hard work starts, in a sense that to coordinate between the lawyers, to coordinate between the fund managers, the trustees, the administrators, it's a huge process. I'm lucky having a legal background, starting as a Pricewaterhouse in corporate tax. We have a good understanding of things, but now with the other members of the team, we can create these beautiful financial products that are ready to go out to market. I only wish, by the way, that the government treated financial planning like the medical profession, because no medication goes out to the public unless it's really totally verified before it goes out and poisons anyone out there. So we always have the investor in mind, even though we're creating products. And because we have the investor in mind, we're led by their interests. Their interests come first to us. But at the same time, it's about how do we optimize risk and return. Now, everybody talks about risk and return, how do you balance the two? Our financial products start by offering a return of 15% upwards. Because after learning in financial planning, all these mediocre funds you have where your superannuation funds go, etc., pays mediocre returns with all the beautiful stories. We start at 15% for a reason, because we understand the underlying businesses. So for example, in the property space, many of you understand property, we would have you effectively partner with a developer because they're using your capital and obtain developer returns and developer margins for your capital. But we do that in a product that protects you, the investor, a preferred equity product or a managed investment scheme. That's one example. We also have other brilliant ideas. Latest of technologies. You talk about AI here. No one's looked after medium-sized businesses with sovereign AI that provides your own internal GPT, your chat GPT, without going out to the outside world and contaminating your data and having the contamination come in. These brilliant ideas we have from founders that we now will provide capital to that will take these ideas to market, providing a fantastic return. Now, given the limited time that I've got, like I promised, we've got a lot of ideas. We've got to stand out there. You can come and speak to me in more detail. How we do distribution for product sponsors, we've got a few bits of ideas because of our financial planning background. Simple example, a developer who sold lots of properties to his clients doesn't realize that those clients have super funds with cash in it that can invest in a product that he creates for his own business. So it allows us to use the same capital to provide a benefit to him. And I'll leave you with the last win-win example. We had a developer who went into mortgagee in possession. Someone who's well-known, very popular, and unfortunately, he came to us late, but we created a managed investment scheme for him and used our Singaporean family office and the digital exchange in Singapore to obtain 120% of his purchase price for settlement and doing the construction lending. That gave our clients up to a 22% return and gave an extra 8 million profit to the developer. That's how you create a win-win. So I'm just spot on time. I'll leave you to look at the last slide, but thank you very much. We're just here to speak to and look forward to seeing you all. Thank you.
Thanks, Suren. Tequila is undergoing a global glow-up, and our next company is leading the charge in Australia. Florcita Tequila is an award-winning brand that has successfully bridged the gap between premium spirits and the booming RTD market. To share their vision for the holiday feeling in a bottle, here is founder and director Pat Neal.
Hey everyone, my name is Pat Neal. I'm the founder, along with my wife Louise, of Florcita Tequila. Today I'm here to seek expressions of interest in our brand as we look to scale both nationally and internationally in production and marketing. But before I dive into the slides, I'd like to play you a short video.
Ever wondered what makes a truly exceptional tequila? I'm Pat Neal, the founder of Florcita Tequila. We've combined our passion for high quality spirits with our love for margaritas and founded a company that's determined to disrupt the market with premium tequila and tequila drinks unlike anything else. Our journey began in the heart of Jalisco, Mexico, where we found the best distillery to bring our vision to life. Florcita Tequila is serious about good tequila. We partnered with the Garcia Ramirez family in Zapatlan del Rey, a hidden gem an hour from Guadalajara. Thanks to the area's unique soil regions, we've been able to create something special. Our handcrafted tequila captures the essence of the region and the art of distilling. In addition to our bottled tequila, we also offer our signature Flor de Noche coffee tequila and a range of delicious sparkling margaritas, which allows us to bring our unparalleled tequila to the multi-billion-dollar ready-to-drink industry. Our secret? A mix of high-quality products and exceptional taste, as well as a passionate team. We believe in creating unforgettable experiences with every sip, transporting you to happy hour in your happy place. Looking ahead, we aim to expand our product range with additional cocktails, as well as introducing both Reposado and Añejo tequila. We're raising capital to expand our reach and bring Florcita Tequila to more people, and we want you to be part of the journey. Investing in Florcita Tequila will help us create a brand that stands for both quality and innovation. Your investment will help us grow and reach new heights.
I think I recorded that one pre-startup, and I think a few grey hairs later, I'm certainly feeling the effects. So why tequila? I guess amongst a sea of other businesses, why am I here with a beverage brand above all else? Well, I think despite its global popularity, tequila remains significantly undervalued in Australia. In 2024, the value sort of attributed to tequila alone was only $836 million, compared to USD of the same time period, which is $11.75 billion. So it's definitely undervalued, and it's probably been overshadowed a little bit for a few reasons, which I'll dive into. Additionally, premixed tequila brands are found to be excessively sweet and use artificial taste, often sort of steering people away from tequila. So what we want to do is really reshape the narrative around tequila and really show how well it can be produced. So we've created Florcita Tequila off the back of a number of different reasons, both experience and our love of margaritas, of course, to bring to the Australian market something that's truly exceptional with a high quality, award-winning quality product. I want to dive straight into this slide just so we can understand a little bit more as to what's happening in the market. So whilst it's the second smallest category in terms of spirits after brandy, it's seeing a significant uplift in terms of popularity driven by US and Europe demand. So although the stat there says 7%, it's certainly more around the 11 to 12% compound annual growth rate, which is massive compared to sort of the spirits industry overall at around 2 to 4%. We're seeing agave-based spirits growing more and more above any other subcategory. And we're seeing tequila transition away from the shot with salt and lime that you may remember to more sort of premiumization and sessionability, which I think through education can be a massive uplift in Australia. We know that the Australians' love of margarita and agave spirit as a clean spirit should certainly hold its popularity and its demand for the foreseeable future. What we've tried to do as a brand is separate ourselves from the other celebrity-endorsed products or Mexican fiesta products driven to chase the Gen Z dollar. We've certainly identified a target demographic of between 35 to 45, which we feel is the right demographic from social cues, higher disposable income, as well as love of a good drink, of course, as well. And what we're trying to do, and you can see this with our branding, is really separate ourselves from the traditional perceptions of tequila, transitioning more from shot, as I said, with salt and lime, to sipping, but actually trying to be the new Aperol Spritz and create that sort of cognitive change in consumers' mindset to say, hey, tequila can actually be really sessionable. And so we're seeing that in terms of uplift of products like limoncello, like Prosecco, and even Aperol, as well as people's drinking habits change, probably from a post-COVID sort of trend where people aren't going out now to get drunk, they're going out to really enjoy themselves. So a little bit about ourselves. My name is Pat Neal. I've got over a decade of commercial experience in FMCG. I worked for Aldi, the supermarket, for over 10 years in buying operations, project management, you name it, both in the UK and here in Australia. So certainly got a great understanding of the customer experience in the FMCG world. I was also listed as one of the top 40 business leaders by Business Elite last year as well, so very proud of that achievement. My wife, Louise, is the real brains of the operation and unfortunately couldn't be here today. She has to look after our children, but overall she's got a background in psychology and really understands and sort of really is intrigued by human behaviour. So we're just a husband and wife duo. We don't have any backing apart from a few key investors, of course, as well, but we're really here to take on the big guns in some of the big beverage brands as well. So I mentioned before, our audience is very much around that sort of 35 to 45 demographic. We see a discerning group of social drinkers more so than not as their drinking habits have changed. So we're looking at mid-career professionals and young professionals, of course, as well, but we certainly don't want to alienate either side of that. But we know that tequila is the one to watch, so we're seeing massive amounts of growth, and I mentioned it before in terms of tequila being around 7%, but it's more so around the 12 to 14% mark. But where we're also seeing growth is in the RTD, the ready-to-drink area, as people prefer the crack and pour or the easy to serve. And we're seeing growth rates internationally of 14.2%, so that's going to hold true, and it continues to grow year on year. So a massive opportunity in terms of the beverage space. Our tequila, well, it's from the lowlands in the state of Jalisco. Now, if you know much about tequila, it's very much very regulated, like champagne. You can only make champagne in a certain region in the world. Same with tequila. We've got a little mum and dad distillery in a little country town called Zaplin Del Rey. If you drove through it, you wouldn't even know you'd gone past it. But they're traditionally known for their corn farming, but the guys there decided to open and run a distillery, which we have partnered with and created our tequila. So we've got nice notes of apple, pear, citrus, a little bit of lavender and jasmine and white pepper. Those flavour profiles aren't normally what you'd associate with tequila. More often you'd probably associate with a gin. So for the Australian consumer, it's actually resonating really nicely with the nice botanicals you would get from gins. And so recently winning 3 awards at the IWSC, the International Wine and Spirits Comp, including gold for tequila and tonic and silver for Paloma and outright spirit. We really feel we've sort of found a little bit of a diamond in the rough in the distillery, of course, as well. So just to quickly go through our products, we've got our award-winning Blanco, as I said there, 40%, really smooth, pairs really nicely as a cocktail or by itself. And I guess as a brand, what we're really trying to say is skip the salt and lime, let's enjoy tequila as it should be had. And so I think it's up for the grabs in terms of the Australian market at the moment, but if a brand like Florcita can come in and re-educate the market as to how to drink and consume tequila, it'll go a long way. And we often compare ourselves to the likes of what Four Pillars did, for example, in the gin industry, and they sort of pioneered that space, and we're hoping to do the same again in the tequila space. What's very popular and due to launch in May is our coffee tequila. It sort of harnesses that Blanco as its base and then has nice notes of Colombian coffee, agave syrup, and a little bit of caramel as well, but perfect on ice, or if you like an espresso martini, it's great. And we see a big gap in the market as well, given the fact that Patron have sort of stepped away with their Cafe Patron. Now I realise I'm slowly out of time, but what I'll say is that we resonate really nicely from a price point as well, because we're only $79.99, and I guess my Aldi background came into play with that to make sure that price and quality were at the forefront of people's mind, and so we didn't want people paying through the roof for that kind of quality. Our coffee tequila is $99.99 as well, so again, really want to sort of balance that price versus quality point, and I think with the product that we've got available for you to sample next door, if you'd like to swing past afterwards, you'll see the reasons why. And I'll quickly skip through, but we do have our range of RTDs available, so we have a lime margarita, a Paloma, and then a few other flavours that I haven't listed there, but a watermelon, a passion fruit, and what's called a limoncello, which is a limoncello margarita. And very similarly, benchmarking ourselves with those against sort of the other competitors in the market, where you get a better quality product, higher ABV for the same price point. So yeah, please, if you feel like this is something of interest to you, pop past. I'm next door, of course. I do have a little bit of Blanco to sample, and thank you for your time. Appreciate it.
Thanks, Pat. Finding the right property in a competitive market is often a game of who you know until now. Homeowner is utilizing advanced AI to give buyers and agents an unfair advantage, providing instant access to off-market opportunities and investment-grade analytics that were previously out of reach. Let's welcome its founder, Gray Damp.
The graveyard shift. Apologies for my voice, it's been a long 3 days. Well, in Australia, property, it isn't just an asset class, it's a national obsession. So it's the first topic at a barbecue, it's a safe discussion at a dinner table, and it's also a generational hot point. So behind all the talk is the quiet truth, and the truth of the matter is many Australians don't know how to buy property, or they're trying to save money when they do it. So right now, those same people are feeling very overwhelmed. They're swamped with listings, misinformation, and they're just not sure about where to go. In fact, many just don't like agents. And so we've got a situation where they're terrified as well about the risks, the fear of missing out, overpaying, or what is the quality of the property, the due diligence of what they're about to buy. So in this context, this is where Homeowner, and particularly our buyer assistance, steps in. In a minute, I'm going to have Troy Rushton, who is the founder. I'm the strategic advisor, and he's going to tell you a little bit more about it. But the problem we solve with this is that people are in trouble, they need clarity, and our buyer assist journey helps them strategically through that process. So here's Troy.
Thanks, Gary. Good afternoon, everyone. My name is Troy Rushton. I hope you're enjoying the event. I'm currently overseas, so can't be with you in person, but I'm super excited to share what we're doing at Homeowner. Now, the Australian property residential market transacts over $400 billion annually across more than 500,000 transactions. Yet, the technology layer that supports this journey is fragmented and inefficient. We're building the connectivity tissue that captures value at every stage. We complement the major portals by adding intelligence and connectivity that turns searches into settlements, and we call this finding a smarter way home. So here's the 30,000-foot view of where we're going. But let's just dive straight into the core of the problem. Now, the core of the problem is a massive quantifiable value leak. Industry data shows over 50% of pre-approved buyers fail to transact. That's billions in lost commissions and wasting lending capacity. The industry has no integrated, technology-driven solution for this dropout rate. It's a journey that starts with excitement and too often ends with exhaustion and lost revenue. That's not just a market inefficiency, it's a multi-billion-dollar problem that we're solving. So how do we solve this? This is our roadmap to the future. We are moving the industry from a fragmented 9-month manual process to a streamlined 6-week journey with our intelligent assist. Our ultimate vision is to create a fully guided buying experience where our technology provides predictive insights and negotiation support to help agents and buyers close deals in a fraction of the time. The engine behind this transformation is our solution, Buyer Assist. It's an AI-powered co-pilot for the home buying journey, but our relationship doesn't end at settlement. We provide a suite of tools for homeowners, from equity tracking to a maintenance hub, creating a lifelong partnership that adds value at every stage of the property life cycle. Our growth is powered by a self-reinforcing flywheel. Our platform creates network effects where every user adds value to the next. This organic loop dramatically lowers our customer acquisition costs and creates a sustainable compounding growth model. So 3 macro trends which make this the right moment. Firstly, AI has matured to handle complex property workflows. Secondly, brokers are desperate for efficiency tools post-commission compression. And thirdly, buyers expect digital-first experiences. So we're at the convergence right now. Now, unlike portals that monetize listings, we own the post-search journey. Our AI-driven buyer intelligence and agent workflow tools create switching costs that portals simply can't replicate. Our strategy is working. We've built Australia's largest geo-targeted social property network with over 500,000 followers, generating more than 3.5 million property views monthly. This powerful social engine, combined with 150 brokers and 2,500 agencies on our platform and over 300,000 buyers accessing our AI suggestions monthly, prove this isn't just a concept. It's a validated ecosystem with significant market momentum. Our model is exceptionally capital efficient. Because of our powerful flywheel and organic social audience, our customer acquisition cost is effectively zero. This allows us to focus our capital on product development and scaling our high lifetime value relationships with agencies. This traction translates into a powerful financial outlook. We are projecting $1.9 million in revenue over the next year, scaling to $20 million annual recurring revenue by year 3 at 70% EBITDA margin at scale. So to accelerate this vision, we are launching an additional $2.5 million capital raise. This capital accelerates our pathways rollout into more than 250 selling agencies over the next 2 years, directly supporting our path to $20 million in annual recurring revenue by year 3. Now, this vision is being executed by a team of experienced operators. We're also proud to have a strategic shareholder base that includes some of the leading selling agency groups in Queensland. These aren't passive investors. They're active partners piloting our products in their agencies, giving us direct market feedback and distribution. So, the Australian market is at an inflection point. The winners will be those who own the data and relationships across the entire life cycle, not just the listing. We're building that platform and we're inviting you to be a part of it. Our strategic advisor, Gary, will be at our stand after the presentation. If you believe in this future and would like to be a part of it and believe in the transformation, please come and say hello. Thank you.
So, thanks very much. You can see how the Buyer Assist part of the homeowner platform is really empowering people strategically. So I'll be at table 10. Love to chat to anyone who's got interest, and hopefully my voice will improve. Have a good afternoon. Thank you.
Gary. Australia produces some of the world's best wool, but for 30 years we've sent the value-add processing overseas. QWool is changing that. By integrating regional processing with fiber tray sustainable technology, they are de-risking the supply chain and capturing massive market value right here at home. To walk us through this scalable opportunity, please welcome their Executive Director, Jonathan Pavetto.
Thank you, good afternoon, and it's my pleasure to introduce the work that QWool's doing as we are in our final round of seed investment. QWool is a nation-building investment in the wool industry, and what we're seeking to do is bring back wool processing to Australia. And we're doing that by building a state-of-the-art green energy-powered wool scour in Blackall, Queensland, followed by further value-adding in Vietnam. These two investments combined allow us to achieve market transformation in Australia's wool industry. It's a billion-dollar market disruption opportunity, and it's one that we aim to share with investors as well as wool producers here in Australia. Australia used to be a global wool powerhouse. It's the Australian wealth that we celebrate today was built on the wool industry, but not so much anymore. But why was it successful? It was successful because we exported wool that was processed in Australia. We value-added it. We kept the value here. And we exported to markets that were diversified. We didn't rely on a single market. And that was just 30 years ago, in all of our lifetime. Now, we don't value-add any of it, and we export nearly all of it to one single market, China. And that's $1 billion processing industry in Australia gone in just 30 years. And business as usual is not better either. Biosecurity challenges, geopolitics, market access with EU regulations pose significant challenges that both Australian producers and the global textile industry are very concerned about. So both ends of the supply chain see business as usual as not sustainable, and both ends of the supply chain want to see market transformation. The wool processing industry from Australian produced wool is a $1 billion a year opportunity. Of that $1 billion a year opportunity, $240 million of that opportunity is Australian wool that is exported to China, processed in China, and then re-exported to third countries. And $50 million of that opportunity is in Vietnam alone. So our disruption pathway is to undertake early stage processing in Australia, continue that process in Vietnam, co-located with our customers, and sell a premium value-added product to the textile industry in Vietnam, which is predominantly co-invested through joint ventures between German, Japanese, and South Korean companies in Vietnam. And the opportunity exists to totally bypass Chinese processes. And we were established by a number of innovative wool producers to pursue this opportunity. We can achieve this opportunity, and we're very confident in being able to compete with China on cost. Quite a surprising statement to make. But we can do that because we have a number of structural cost advantages in Blackall. For example, access to the Great Artesian Basin, which produces water at the right temperature that we need for scouring. And that's around a 20% OPEX saving, just on that point alone. It's some of the best renewable energy generation potential in the world, and that can power our plant. And the logistics and supply chain efficiencies that we can achieve by being able to export direct to a place like Vietnam, as opposed to exporting to China, upstream to the scouring plants, downstream to the ports, and then down to Vietnam, is extraordinary. And you can combine those things together and we have a market-leading OPEX advantage in wool processing. Our momentum is building. The industry is investing in QWool. 50% of our foundational investors are wool producers because they recognise the market opportunity. They live it every day. We've got Queensland Government backing through $1 million grant to accelerate our development proposals. We've got concessional finance available through the federal government with the Northern Australia Infrastructure Facility, Export Finance and the National Reconstruction Fund, because we're bringing back manufacturing to Australia. Our scale design is complete. We've got build partners selected, our land acquisition is underway, our planning and environmental approvals have been submitted this week, and we have got strong offtake interest from customers in Vietnam, and we're very strongly supported by Austrade and DFAT in Vietnam because they can see the potential. We are currently seeking our final round of seed funds. We're seeking $1.6 million at $1 a share to bring us to our final investment decision. The use of funds is primarily to finalise our offtake partners, finalise our plant engineering and due diligence in Vietnam, purchase the land in Blackall, which is only $200,000 for all of our industrial site, and to establish our corporate structure for our final investment decision. We have a been there, done that team, low risk team. Our executive chairman, John Abbott, who's with us today, you have a chance to meet him this afternoon, has delivered many of these projects in Australia and across the Asia Pacific. One of our directors and foundational investors, Andrew Martin, is a leader in the wool industry and has been a leader in the wool industry for 30 years. And Peter Sackett, our owner's engineer, is the former engineering manager at the last Australian tops making plant in Parkes. So if we're looking at the right people to bring this to market, we've got them. Myself, I'm an economist and I'm fifth generation agriculture, so I can understand the opportunity ahead. Finally, we've got 3 value inflection points which would be of interest to someone investing at this stage. The first is moving from concept to bankable asset, and we expect that to happen in the middle of this year with our final investment decision. The next is going from asset to a cash generating platform once we start operations in late 27, and that is when we seek to list on the ASX. And our third is going from a single plant to a strategic portfolio from 28 onwards, and that is going up from 5% of the wool clip with one plant up to 30% of the wool clip, where we can become a global textile powerhouse and a real mover and shaker in the global textile market. So the question for you is, are you ready to invest in the renaissance in an iconic Australian industry? If you are, we look forward to speaking with you, and we look forward to sharing the information with you later today. Thank you.
Thanks, Jonathan. The next presenter is pioneering recyclable printed solar technology that can be applied to surfaces where traditional panels simply can't go. To tell us more about it, please welcome the CEO of Kardinia Energy, Anthony Letman.
Good afternoon, nearly good evening. Thank you all for your time this afternoon. As I say, I'm Anthony. I'm the CEO of Kardinia Energy. And today I'm going to talk to you about printed solar. So we've moved from successful pilots and now we're at the stage of commercial scale. We're raising up to $5 million to build our first of a kind manufacturing facility. And what this actually delivers is a blueprint towards gigafactory expansion. The capital allocated is for talent recruitment, facility fit out and CapEx, with production commencement due in Q2 2027. And we're already backed by $5 million in non-dilutive federal, state and Commonwealth grant funding. So ultimately we have a potential of $10 million to build Australia's first fully sovereign commercial scale solar printed facility. And so what is printed solar? You may have seen it on my desk earlier, but actually this is what it is. And so what this is revolutionary next generation solar energy. It's made using high speed printed electronic inks. There is no silicon in this technology. There is no supply chain reliance of what we're traditionally used to. The nature of the technology, the nature of the build ensures that it's very low cost. Currently at pilot scale, we have converted a wine label machine to make energy, to print energy. And as you can see, it's ultra lightweight. It's incredibly flexible. So you might start to think about some of those product opportunities or placement opportunities. It's rapidly deployable, and I'll come on to that in due course. But also, it's fully recyclable, and we do that in-house. So what printed solar has the opportunity to do is turn the entire thinking about solar energy on its head. So what are the simple economics? The question I've been asked quite a lot today. We're used to asking, well, what's the efficiency? What's the lifetime? What's the cost? But if we turn that on its head, and I can say that printed solar essentially needs 3 to 5 times more space than traditional solar, but it's 10 times cheaper because of the nature of it. It brings a different paradigm, a different thought process of why are we chasing efficiency when there's a different way to look at this. And with such a low cost way to manufacture and install printed solar panels, we're starting to look at generating of paybacks of less than 2 years on that technology. What's the market demand? What's the product? Well, in Australia alone, there's about 70 million square meters of industrial roof space that cannot take the weight of traditional solar panels. So what we're saying is we've got the space in Australia. We can cover these spaces. So rather than thinking about efficiency, we're saying all we need is a bit more space. And then we start to think about areas where we can use solar energy in spaces that we've never thought possible before. We've had interest from over 120 countries and counting, unsolicited inbound, across thousands of applications. You can come and see me at the stand later and ask me an application. But all of these are genuine demand interest that we've had. Stadium infrastructure, the roofs, they're lightweight. They can't take the weight often. We can use solar panel, printed solar. Industrial greenhouses, corporate events, all of those enormous deployable roof spaces. Unique structures, where actually they do need to think about a different environment. Live events, and I'll come on to that in due course, where there's space. It needs to be deployed and it needs to be moved rapidly. We've had a huge opportunity in humanitarian and disaster relief. 30% of our planet has no access to clean fuel for cooking. 10% of our planet has no access to electricity alone. Let's start to think about and reimagine how we can use different types of energy technologies, and we're not just firing up, for example, a diesel generator. Remote mines, for example. Enormous opportunities to deploy a different type of energy. And so we've been on a journey of testing the technology, and now we're absolutely ready at that commercial scale up. So we've put it on a roof just outside Newcastle. It's been tested in extreme environments, and it lasted for over 3 or 4 years before we took that down, and we can put the next generation on. It was on a solar arbor in Lane Cove. What that demonstrated was a unique structure, putting it in a curved environment, in a lightweight environment, again, testing new technologies to its limit. In 2022, we helped charge a Tesla around the circumference of Australia. So the Tesla would go into areas where it was remote, he would park up for the day, we would roll out the printed solar, and it would help charge a Tesla to the next station. And so we believe Kardinia Energy is redefining solar with a lightweight, flexible, recyclable, and ultra-low cost printed technology. We have exclusive IP with strong defensibility. It's been decades of R&D. Market validation, well, we've just finished a world tour, which I'll come on to. We have commercial pilots and extensive letters of interest from major property groups across Australia that have no other alternative, in fact, Australia and globally. And superior economics. Paybacks of less than 2 years. We'll get down to 10 cents a kilowatt hour in certain areas, and we open up enormous new markets. There's a clear scale-up path. The printers that we use will be rapidly replicable right across the world. And we've de-risked this funding nature with the non-dilutive government funding. So what you have today is a rare chance to back a world leader in disruptive, sustainable solar at the scale-up inflection point. And I'll leave you now with an overview of what we worked with Coldplay for 2 years. We've just finished traveling 40 countries and demonstrating the technology. Thank you very much for your time. I'll be outside for drinks and at the stand later.
Thanks, Anthony, for sharing with us this promising opportunity. Running a medical practice is complex, but the billing shouldn't be. KPeyes is an AI-powered financial automation platform designed specifically for the healthcare sector. Here to explain how they are streamlining the business of medicine is Director Mike Herman.
Thank you, everybody. Lucky last for today. Everyone in this room has been to see a GP in the last 12 months. And when you presented this little green card after the initial consult or before the consult, unbeknownst to you, you created a bit of chaos in the GP clinic. A lot of chaos. Now, KPeyes has fixed that chaos, but I'll tell you what happens after that basis. So, once you've had the consult, all the money comes from Medicare into the GP clinic. And at this point in time, about 80% of GP clinics, they need to manually calculate what the GP gets. Now, either the clinic's receiving the money or the GPs are receiving the money, depending on which state you're in, because of payroll tax and a few other things. But at the end of each pay cycle, whether it's at the end of the second week or the month, you need to get a practice manager or an admin person or your accounting team. You've got to manually download the Excel spreadsheets out of the PMS system, calculate it all. You've got to do the invoices. You've got to generate the invoices, send them out to the GPs, and then you've got to put everything into the Xero or MYOB or whatever the case might be. If the GPs get all the money, you've got to then invoice the GPs and wait for the money to come back to the clinic. And hey, we've all got staff to play. It's tedious. It's hard, it takes a lot of time. We have clinics that take anywhere from 20 minutes to a whole day to do the pays. We've got one clinic with 24 doctors. It takes them a day and a half to do the pays. KPeyes has got that down to 5 minutes, and I'll show you how. So we automate the calculation of the service fees, whether it's going to the GPs or it's going to the clinics. We automate the disbursements, we do the calculations, we read the PMS system. We automate the invoices, we automate the reconciliation, we push everything into the accounting system so you can settle, you can track where it's all going. We've got one ecosystem there. We've created this digital layer over the PMS system, over the banking system, and obviously over the accounting system, just to make life really, really easy for the GPs. How big's the market? Right now there's about 7,000 clinics. There's 7,000 dental practices, 200,000 allied health, and obviously a lot of specialists. Our platform is subscription-based. We get transaction revenue from the direct debits. We're currently in about 110 clinics at the moment, and we're just looking to scale up on this basis. We're going to put in a data automation system and also we've got AA over the top of that, and eventually we want to do KPeyes books. So our primary market at the moment is the GP market, but next year we want to move into the dental market because they're in the same spot with the GPs. Lack of oversight, complex billing systems, yet manually doing the payments, manually pushing stuff into the Xero platform. And as I said before, we've automated that whole process. So the founders, there's myself, been in the game for about 35 years. I've got lots of broking experience, been in the medical industry as well for quite a long time. We've got David Lee, he's a forensic CPA, also been in the medical side for quite a long time. Shannon Murphy, another accountant of ours, also a CPA, but been in the medical side a long time. But more importantly, we've got John Deary. He's an owner of 3 clinics in Canberra. He's been backing us for the last couple of years, and he funded us initially to get to this point. So we're building this financial system for practices and practitioners to work together. As I said before, we're already in 100 plus clinics. We are partnering with the NAB. Now the NAB has the biggest healthcare bank in Australia. We've been liaising with at least 65 of their health banking managers, and they're ready to push KPIs right through the whole system. We've signed agreements with Tyro, we've signed agreements with HiCaps, and we're well positioned, in the Medicare market to push forward. So we're scaling up. We're ready to go. The platform there is we're probably what we call a Series A fund. So we're looking to raise 1.8 million to accelerate this product out through the market. We've got a bunch of engineers working for us here and overseas developing the product and the platform, but we just ask you to join us over the journey to put this out there and to make compliance around what the clinic's doing. And hopefully the next time that you go into a clinic, maybe 12 months from now, and you just ask them, are you using KPIs? And if they say yes, then guess what? You're not causing any more chaos. Thank you.
Thanks, Mike. To conclude our formal sessions for Emergence 2026, we have one of our most anticipated panels, which is the Family Office Investment Trends. Please join me in welcoming our final group of panelists to the stage, starting with our moderator, Lel Smits, Managing Director at the Stock Network, Kevin Shen, Investment Director at Skyfield Capital, Chris Broad, Director at Left Field Capital Group, and Stephen Katz, Co-founder and Managing Director of Partnership Capital. Let's all welcome them on stage.
Thank you so much. As everyone's taking a seat, it's a good idea, I think, just to look at the significance of family offices in Australia and the rising significance. Last year, KPMG reported around 2,000 family offices exist in Australia, and the Australian Private Capital Yearbook estimated that family offices accounted for 40% of active private capital investors and private equity and private credit in the last 12 months. There is no doubt that family offices are rising in importance and in influence, and I certainly know this firsthand because I work with CEOs, and there is not a week that goes past when someone says, can you introduce me to a family office? So what you do is very sought after, and I'm sure our audience will appreciate your insights today. So to shed light on family office investment trends, I'm thrilled to introduce our panel members today. To go into a bit more detail about their specific focus areas, Kevin is Investment Director of Skyfield Capital, a family office providing long-term patient capital to support both public and private companies in Australia and globally. Chris Broad is a Director of Left Field Capital Group, specialising in securing alternative real estate debt products for wholesale and sophisticated investors. And Stephen Katz is Co-founder and Managing Director of Partnership Capital. They are an Australian PE firm which specialises in minority equity positions, seeking to partner with owner-founders to grow their businesses over time. To get to know everyone a bit more closely in their own words, we're going to ask them a question which hopefully is like a rapid-fire question. Usually I say one sentence, but I don't mind if you want to go to a few sentences. When you look across the next 5 to 10 years, what is the single biggest shift you expect in family offices, how they allocate capital across public, private, and alternative markets? Starting with yourself, Kevin.
Thanks for having me. Great to be here. I think I want to probably say three things. One is public versus private. In the last 10 years, there's been almost an inverse liquidity premium where private companies are staying private for longer and valued very highly. So would the public liquidity premium revert at some stage? Next is US versus China on the AI front. And I think thirdly, everyone's talked about AI. Who are the casualties and who are the winners?
Excellent, thank you. And Chris, how about yourself? 5 to 10 years, what are you seeing in the family office space?
Yeah, sure. So, I describe myself as a bit of a one-club golfer. So I live in the product world. Our world is private debt, so I won't purport to talk about things that are well above my pay grade. But I think if you look at the asset class where we sit around private credit, it's obviously been well established within family office portfolios. I think what you're sort of finding within that is I think that'll remain a thematic, but how people participate in that and how they kind of sub-allocate within that, that's probably going to be one of the themes within that asset class. Other asset classes, I think there are, there's a whole range of different things, but what we're sort of seeing is we're one end of the barbell, where we're perhaps in that sort of yield, more defensive area, and there's a whole range of things that could participate in perhaps at the higher return end.
Excellent, thank you, Chris. And Stephen, how about yourself? Next 5 to 10 years, what changes or trends do you think we'll see in the family office space?
Oh, look, I think it's product. As there's a continued transfer of wealth, family offices are going to become, in number, just an enormous group of people who will be investing across a wide spectrum of different asset classes, and that will require people to come up with different products to satisfy different risk appetites within individual family offices between members, some high risk, some averse. So the more product out there, I think is going to be imperative to satisfy that demand.
Thank you. Now, for those that are joining us, we're going to restate the importance of family offices, the fact that they are growing across Australia, they're growing in importance and influence, and there are changing trends now that we're looking to identify and explore. One of those themes is liquidity, cash yield, and changing preferences of family offices. They are increasingly prioritising annual yield, shorter lockup and downside protection. And while Stephen still has the mic, you mentioned to me earlier that annual dividends and liquidity have become more important than money multiples. How is this reshaping the types of businesses partnership capital invests in? And also, how do you structure deals to deliver annual yield?
Yeah, I mean, that's exactly right. Part of the reason that, together with my other co-founders, we started Partnership Capital was an understanding and a recognition that cash yield, or DPI as we talk in the private equity world, is an increasingly important aspect for any investor. People don't necessarily want to invest in a fund and lock that money up for a period of 5 to 10 years only to get a return after that period. If we can offer them consistent yields from an alternative asset source such as private equity, we believe and are seeing that there is very strong appetite. Money multiples and IRR, all of those are still really important, but to say you're returning 5, 10, 15% per annum in cash to your investors, I think that's an increasingly good selling point for any fund like mine. What does that mean in terms of businesses that we look at? Well, fundamentally, anything that impinges on the conversion of EBITDA to free cash flow naturally will mean we can't pay a dividend. So anything that's got high leverage, businesses that have very high capex, software businesses that have a fantastic businesses but reinvest everything they make back into their IT platforms, they're all fantastic businesses but not ones that we will look for. We're very much more service-oriented businesses, businesses that are, as they say, very boring but generate great cash flow. What does that mean in terms of structure? Well, fundamentally, what we would like to do from a minority investment perspective is have direct alignment with our founders who we're investing in. And if we can do that through just pure ordinary equity, we do. But sometimes we might need to structure the investment with pref equity to ensure that we can get that yield that we're looking for.
Thank you. And Chris, private debt is often positioned as a yield-first asset class. How are you seeing family office preferences around liquidity and regular distributions shaping demand for different types of credit products?
Yeah, for us there's probably a couple of things there. One is ticket size, the other one is duration risk. So I think what we've seen is, as we talk amongst our investor community and particularly amongst the family offices, everybody's got some war story about a loan that they've been in for a very long time, and there doesn't seem to be a material liquid event. It is an illiquid asset class, but typically the way that we tend to address that is through ticket size, duration, and also for one project, what we might do is actually chop it up into 3 separate loans. So you're in a pre-development phase, you're in a construction phase, you're in a completed or stabilisation period. So whilst the security remains the same throughout, the actual loan term, there may be 3 separate loan terms within that one project. They match the characteristics of it. Every time you get to the end of that phase, there's a liquidity event. Your option to roll into the next one is, at your behest. You don't have to do it. So I think a lot of it is to do with really just how long is this going to go for, and can you manage the ticket size, because the bigger it is, the more risk you have around overrunning time, market going against you, and costs going against you.
Yes, and Kevin, across listed equities, VC and private credit, where do you see the most attractive opportunities for family offices that are seeking yield without sacrificing long-term growth opportunities?
I think for us, we look at yield separately from growth. So yield is a treasury function for us almost. So that includes some real estate, private credit and fixed income. And in that bucket, we tend to allocate and take the dividend or take the returns that pays for operations, pays for other things. And if there are good opportunities in whether it's private credit and the fixed income side, we can recycle capital, or we can lean in and over allocate at some point. Now on the growth side, we focus on equity, both private and public. And we can be flexible in terms of if there's dislocation in the capital markets that are short term, we can lean in and invest for the long term. So I think currently with what's happening with geopolitics and AI, the public markets are quite exciting. It's presenting opportunities, but we have to be careful and do our due diligence properly.
Yes, and that really brings us to our second theme, which is all the noise that we have in the market. And family offices are not immune to that. So when it comes to more managers, more products and more noise, how are family offices choosing? Chris, you've said that there is a massive spectrum in private debt managers. What are the filters that you think family offices absolutely must apply to cut through this noise?
Yeah, so I think the reason why it's so important in the space at the moment is you have a market where there are relatively low barriers to entry. You're also in a situation where it's largely unregulated compared to, say, the big 4 banks. And also, you've probably had a period where the amount of capital that's there versus the level of quality opportunities has been perhaps sort of out of whack a little bit, and therefore there's always risk around misallocation because you're not picking the right ones. So I think, if you look at that hierarchy, you've always got a question around what's the asset class, what's the asset manager doing, and what's the underlying transaction. So I think for many of our investors, it's really a lot of it is about look-through, really having no dark corners within your portfolio. So one thing that we do, which is, it's quite laborious, but 3 or 4 times a year we're putting out an investor report, goes to all investors and has every single loan that we have as a loan investment at the moment. And part of the purpose of that is simply to say, if you're investing with us, it's going to be somewhere within this document. I think that's a really good storyboard around transparency. I'd also say that there's a lot more scrutiny just around an initial set of questions about you as an asset manager. And there are not unusual questions that you get in normal forms of due diligence, track record, people, all of the usual suspects. I think what is also becoming more apparent is really just understanding the structure of the loan and who's involved amongst the various stakeholders. So potential conflicts of interest arise around, is the investment manager managing more than one class of units within the same loan, and who are they really looking after? Is it becoming debt or is it equity? Where does it actually play? And then secondly, just understanding who are the parties involved in actually executing the product at the end of the day. So the builder, the developer, the people who are working in that, you just got to make sure that it's not a fee clip for everyone who's in the IM, and that there is a genuine distinction between who's doing what. So that's really why we try and unpack a lot of that and be really clear about our role. And as I often say, you know, the best deal you do is the one you don't do, right? The ones that end up on the cutting room floor. So just being transparent about why you don't do some of the deals that you do see.
Yes, and that brings us to Stephen from a PE perspective. What do you think family offices misunderstand when evaluating a minority equity partner like Partnership Capital?
Sometimes people look at minority as, well, you don't have control. And in some instances, that can be true. But invariably, where in our estimation you're investing north of 35% and invariably 40 to 45%, there are various protections you can put into the agreements that do afford you the level of protection that you would otherwise get if you have a majority position. The other thing that distinguishes Partnership Capital relative to other investors, particularly minority investors, is it's very important to us that the stub of the equity that we don't hold is held by the people running the business. We're not really investing in executive management teams. And again, that's a level of protection, because there's no greater protection for our capital than our partners' capital who have skin in the game. And the more skin in the game, naturally, the more rational they will be with respect to the decisions we make. So one, ensure we have some minority protections around major decisions, and two, ensure that our partners are aligned with us in terms of the ownership of the business.
Yes, excellent. And Kevin, in public and venture markets, selection pressure is always intense. What signals do you see as genuinely predictive of manager quality versus just marketing?
I think manager selection is really people selection, and people selection comes down to, first and foremost, relationships. So I've been fortunate enough to have worked in the alternative space. So firsthand, you know who some of the good players are, and you can follow them as they leave different firms. So in private equity and in private credit, scale matters, brand matters, and culture matters. So first and foremost, obviously, the track record needs to stack up, and then it's really evaluating the key people, why they want to do what they do, why they have a reason, what their edge is, and also the where they have come from, the pedigree, the firms they've been at. You know, certain networks tend to produce a cluster of great managers. In the US, you've got the Tiger Cubs in infrastructure, for example. The Macquarie alumni perform very well, and then it's really referrals, relationships, and more there are forums where you can hear key people speak and speak for a long time, and you can actively reach out to people who have presented at conferences, have been on long-form interviews that you resonate with. And I think lastly, what Stephen said is really important, alignment of interest, how the managers and key persons are aligned to the performance and their personal stake in the fund as well.
Yes. Now, I'm a former finance journalist. I still do it now, and I have the stock network. So this is the theme that I personally like the best. It is the macro volatility and portfolio construction. What's happening in the world and how are we making investment decisions aligned with that? Interest rates, geopolitical instability and market cycles, they are forcing family offices to rethink diversification and time horizons. So Stephen, if you could outline to us, how has the more volatile macro environment changed the way founders and family offices are thinking about partnering with minority investors?
Whether it's minority or majority, there is a distinct difference between a very stable environment versus a volatile environment. And again, some might argue volatility is a concern, but it actually presents opportunities, both for investors and for family offices. So if you take companies who are looking for investment, it's either a point in time where they can see opportunity but don't necessarily want to reinvest, and so they look for a partner to help capitalise on that opportunity. Volatility generally brings that out quite a bit. Or equally, it might be a family, a business that realises, look, it's a little bit too volatile for us. We still see opportunity, but we'd like to take a step back and take some money off the table. So we generally see periods of volatility as great investment opportunities for us because they're actually increasing in number. Family offices is a little bit different, depending on the risk appetite. Most often than not, a family office has a very long-term investment horizon. So small periods of volatility don't concern them. It's where there is an extended period of volatility that's very hard to value risk, is when from that perspective there's an element of concern. And really, other than major structural changes, whether it be the GFC or COVID or elements like that, broadly people are quite rational when it comes to the volatility that we're seeing at the moment, recognising that they're not in it for 1 year, 2 years, but it's a 5-10 year horizon.
Yes, keeping your eyes on the prize. Chris, private credit has boomed in a higher rate world. How much of this demand is cyclical versus structural, do you think?
Yeah, I think if it's a cycle, it's been going on for a very long time. It's becoming systemic. So whilst the origins might have been in structural change due to global financial crisis, regulations of the bank, Basel regimes, etc. I think it's now become much more of a value driver business, i.e. that there is a distinct place for it on both sides of the balance sheet, and is about striking that equation between what's right for the borrower and developer and where's the return for the investors. So typically, private debt will trade at a price that is X% above the risk-free or the cash rate. That has become a sort of a fairly normal place to trade. I think really where the value proposition has kicked in that is for borrowers, it's sort of one less thing to worry about. So if you find a good partner on funding who is predictable, turns up when you need to show up, delivers on the day, it's just one less thing for them to worry about because they've got plenty of other things to worry about. So whether it's around flexibility, timelines, sensible risk-based approach to loan-to-value ratios, there's a whole range of factors why I think it's sort of here to stay. I think why would that change from what we've seen today? It probably comes down to performance of the sector as a whole. And then within that, how are pockets of people actually performing? So are you then becoming more focused on asset managers within that group as opposed to the whole asset class and just throwing darts at the dartboard? So just one quick example is, say you look at residential, and everyone loves to just talk about the Australian property market. I mean, there's kind of no such thing. It's geographical, it's sub-asset class, it's ticket size, it's all of the above. So a recent example would be when we had that big uptick in rates. What you saw in residential is that first-time home buyers were out, investors were out, but what you saw was, having the equity in your property was king. So downsizes, townhouses, 2 to 3 bedroom apartments, that's where we focused on because we could still see there being a thriving market in that space. So volatility for us is probably more about what we're doing with the sub-asset classes, and that's how we're sort of managing the risk within it.
Yes, and Kevin, across private equities, venture and private credit, which segment do you think is mispriced relative to the macro environment?
I'm not a macro investor, but sort of, looking out again, the public versus private theme, how we express our views. Being a family office, we can be both tactically agile in terms of deploying into short-term mispricings, and we can also express our conviction through duration by holding things for a long time. So, for example, and China just went through a 4-year bear market. We were bullish on China technology maybe 4 years ago. That's probably a little bit early, which meant we had to hold through a drawdown where we could double down on our investments. And because we have no outside investors to answer to, if we did our work and have conviction in companies or sectors, we can afford to hold on for a long time. And that's paid off for us in this particular instance. And in the future, again, we are long-term partners on the private side to mostly to all Australian companies, Australian founders. But on the public side, I think there's a lot of opportunities in both the US and Asia within this AI theme.
Fantastic. And as we look to sort of wrap up now, we're going to look to the future and ask what the one theme is that you think that family offices are overlooking right now? Stephen, perhaps yourself.
I guess we're pretty fortunate in that we don't have an ESG policy. That might limit where some of our money comes from, but as a result, we're quite bullish on defence in all manner of forms. And I think whether it be ethical or ESG concerns, that's a very difficult subclass or class for people to invest in. We think, therefore, it's an opportunity and probably one that's being missed by a large number of family offices.
Excellent. And how about yourself, Chris?
Small is beautiful, so sometimes you feel like it's a lot more effort to deploy money on a number of different loans as opposed to writing a big cheque and putting it away for a long time. We just think there is a lot more value and a lot more risk in the smaller end of the ticket size in our space. So that's something we think is the right place to be at the moment.
Wonderful. And Kevin?
I think on the public side, ChatGPT came out 4 years ago. DeepSeek came out early last year. So China is sort of 2 to 3 years behind US in terms of where it's at in the AI CapEx cycle. So you can look downstream from what that means for the supply chain and the models, and you can say what's happened in the equity markets for the US will happen in China with a little bit of lag. And I think increasingly we're seeing, AI is sort of like the back of the iPhone. It's designed in California, but it's made in Asia. So all the equipment, the memories, energy, a lot of that resides in Asia, and there's an opportunity for that on the public side. Now, on the private side, it's a little bit different. We like to support local founders, and I think we want to look at things that AI can't disrupt. So AI is making companies easier to start and founders to build great companies with less people. And I think one thing they can't disrupt, Elon Musk said, is one is live experiences. And I think two is, physical goods, branded consumer products you can touch and feel and makes you feel a certain way. So Australia's been pretty good in punching above its weight in that sector. It's produced, Aesop, R.M. Williams, Culture King, Inku, those kind of companies. So we want to meet the founders who are looking to build the next consumer brand, whether it's aided by AI or not, but it's cultural driven, it's taste driven, and if you're building the next White Fox or Gymshark, I'd love to meet you. Yeah.
Well, I'm sure there are lots of people that would like to meet you. That does conclude our Family Offices Investment Trends panel session for this afternoon. Thank you so much for joining us, and thank you to our guests for their expert insights into family offices. Thank you very much. Have a lovely day.
Thank you very much to the panellists. So that, ladies and gentlemen, concludes Emergence 2026. Now we're obviously going to get to, there's two more important things for everyone leaves. Two more important things is that, number one, obviously we've got drinks and networking over in the exhibition area on the other side. I want to say a big thank you to, again, all the sponsors, all the speakers, all the companies that featured. And then the last and most important one, I want to say a big thank you to the Wholesale Investor team. Typically at these events, what happens, everyone comes and thanks me for it. I just want to say, please take the time to go and thank everyone that you're seeing, whether it be Jade, whether it be all the team outside, because they're the ones that make everything run absolutely seamless for everyone in the room. And from whether it be the presentations, whether it be the AV, whether it be the coordination outside of all the logistics that goes on. If anyone understands, running events is a combination of marketing, logistics, and organisation masterpiece in pulling it all together. So please make sure you take the time to do that. Ladies and gentlemen, thank you for joining us at Emergence 2026. I've had the most fun 3 days networking with all of you and enjoying the conversations. Go and enjoy your drinks. Thank you.